excited to be here today. When Josh said he had a conflict because of the reschedule and the conflict was taking a little vacation time, I wouldn't even let him think of trying to dial in. Yeah. This is my job.
Yeah. Well, Mark, how are you doing this morning, sir?
Good morning.
I'm well, thank you. It's been a kind of a whirlwind couple of days, but anyway, good to see you all here. I see we have obviously the treasurer, superintendent, secretary, auditor Racinas, Madam Director. It appears we have a full quorum, so I guess.
Good morning, Governor. Yes, we do have all board members present, and this is a special meeting of the State Loan and Investment Board. It's the Treasurer's Office working session, and that is the only thing on the agenda today. So, Mr. Chairman, I would turn it over to the Treasurer.
Oh, thank you, Director Scoggins. And we did invite our 90-member board of directors today. That's the state legislature. I don't know how many of them are going to show up, but as I've been informed over the course of the last few days that indeed they are the board of directors of the investments of the state of Wyoming. So we hope that some of them show up today. Kind of a brief agenda item here. Becky is going to walk through the RBK stuff. I think you guys have got the agendas there. So that's basically her and her team is going to look at we'll first start with the market evaluation outlook. Patrick's got about 4 pages on that. And then we'll turn it over to Becky and she'll roll through and kind of give you an overview of some of our objectives, some survey results from IFC, and some of the peer comparisons about what the other sovereign wealth funds and investment entities, how their asset allocation is as it is compared to ours, kind of on before and after view. So Patrick, let's start it off with you and we'll get an overview here.
Great, thank you, Mr. Treasurer, Mr. Chairman, members of the board. My name is Patrick Fleming. I'm CIO for the Treasurer's Office. And first off, I'd like to just start off by saying thank you for spending the time to go through this. I know your schedules are very busy, especially at this time. But as you know, that this is what I deem the most important meeting of the year. Asset allocation, as you know, is the number one determinant of funds performance. And so spending the time and effort to really understand this, I really appreciate your time and effort. As usual, every year we start off with where we are in the cycle to try and get a big picture. As you know, we're not trying to look at what the next year or two types of returns will be, but where we are in the big cycle and the valuation where we are. As you know, we've continued to get more expensive over the years. You know, we've said how the market has been very pricey, and it just becomes even more expensive as we progress on. And this is primarily just because of the liquidity that's in the system. We have a tremendous amount of liquidity. Money supply, M2, is at 25%. The Fed is intentionally pushing money into the system to make sure that we get this growth back after this the COVID issues that we've had. And if you turn to the presentation that I have, which is this State Loan Investment Board market valuation, you can go through, and what we do as our group is every week we look at market valuation on a short, intermediate, and long term. And if you look at the U.S. stocks, this is the broad U.S. stock market valuation. You can see that other than the forward PE, which is at the 92 percentile as far as richness over the last 10 years, everything else is in the 99 to 100 percentile of expensiveness. So as far as stocks, I would argue in my 40 years, this is the third most expensive stock market I have seen. Tokyo stock market in 1989, and the U.S. stock market with the dot-com bubble would be a little more expensive. But if you go to the bond market in the next slide, in the previous two examples that I used, the bonds were not expensive at that time. And as you know, with a diversified portfolio, it's great to have two different asset classes that hopefully will work off one another. And that's not the case right now because as I've mentioned to you numerous cases, the bond market is just as expensive. And as if you look at this, other than bank loans that are at the 11th percentile or 89 as far as expensiveness, every asset that we look at and invest in is in the 97th to 100 percentile of expensiveness. So unlike previous times where you had a higher yield to offset any weakness that you would have in equities, we don't have that luxury now. So the bond market, which is typically used as more of an insurance policy, it is negatively correlated. When equities go down, the bond market goes up. We don't have that luxury now. So for instance, the 7-year treasury, which is the equivalent of what the duration of our core bond fund, which would be 7 years, approximately 6.5 years. If the equity market sold off and we had a rally in bonds and we went to zero from where we are right now, which is about 1.3%, we would earn 9% in upside on the US Treasury bond portfolio. So that's the only, typically the ballast you would get a 20 or 30 or 40% return. Now we would have a much lower return from our fixed income portfolio. And that is something that the investment committee has looked at, and we had a lot of consternation about what the role of fixed income would have in this portfolio. And that is why we are going to show in some of the preceding slides that we're looking to reduce our core bond fund in a meaningful way. And that is the reason why. The next slide would be private equity. Private equity, many would argue, is public equity that just has leverage. So it has a higher return, but it also is one of the most expensive it's been in recent years. You have a lot of dry powder, money that is waiting to go in to the sector, which we've had for many, many years. But it's across the board. So there's very few asset classes that we own that are not very expensive. So obviously that is a concern for us. And Becky is going to go through and show you in the next few slides. But as you know, we always have the capital market assumption page that they spend a significant amount of time. And as we know that this is kind of just a guideline of where we view or where they view the valuation should be. They spend a significant amount of time doing this. But if you look at their projections for both US and international equity, which is how we kind of look at it, and if you just take their projections for the next 10, 20 years on the, if you said 50% international, 50% US, you're going to come up with an approximate, if you did a 60-40 portfolio, what kind of yield would you expect? It's about a 3.5% return that you would get from the 60% of your portfolio, and the 40% of the bonds at a 188 for the ag, 1.88% is what their forecast would be. That gets you a total return after a 2% inflation of 2.25%. This is significantly lower than the last 50 years. The last 50 years, that 60-40 portfolio has averaged about 5%. So I just want to make sure that everyone understands this is a very difficult environment to try and find value. And, you know, the bottom line is we can't go into T-bills, you know, that you have to still get a return or try to maximize the return for what the state is trying to achieve, because as you know, we need that interest income to be able to fund the state. And so what the IFC committee and the committee has done, and with the Treasurer's leadership, is really trying to focus on what can we do in this very difficult environment to try and get an additional return without increasing our risk in a meaningful way. And so in the pages that you're going to see in the next few slides and throughout the day, that is what the committee has been trying to focus on, and what we're trying to do is trying to increase the return without taking a significant amount of risk because of where we are in the valuation spectrum. So with that, Mr. Chairman, I could stand for questions or pass it on to Becky.
Patrick, one thing that you've, I think, alluded to and put in perspective is that if the interest rates went down to 0, we'd make 9%. Now, if the interest rates went up 1.3%, the converse of that would be true, that we would actually lose money in the bond market, correct?
Mr. Chairman, Mr. Treasurer, that is correct. So for instance, right now, the Barclay aggregate so far this year has lost 3.4%. That has never happened in the last 21 years of this century anyway. We've had other periods where we've had a worse part. But the duration right now, and which I've mentioned in other meetings, the duration on our core bond fund, which is the Bloomberg Barclay aggregate, is 6.4 years. That's the highest duration it's been in some time. And as rates go up, the mortgage part of that causes the duration to increase, which means it's more risky. So every 1% move in interest rates, we would lose 6.4%. In the other part of it is the amount of risk, the credit quality of that index has deteriorated as well. So now we're 50% of the aggregate now is BBB rated. So you've seen not only a higher risk in the aggregate, but also the duration and the credit quality has deteriorated. So that is just in our intermediate. Now, if you look at the long end, as the treasurer mentioned, a 1% move, the long duration fund is about 17. So a 1% move there would be a 17% loss. So when people say bonds are safe, I would take an exception to that. And that's part of the reason this, and we'll get into it, but the bill that's being put forth in the legislature right now, which we're hoping for, is to redefine our risk parameters to look at what is the risk of our portfolio, as opposed to some predetermined definition of what the risk of a stock or a bond would be. So the bill that's being put forth is to say, okay, well, what is the risk of a 70-30 portfolio? And that should be what figure you as a Slib board would determine how much risk the portfolio should be, as to saying a bond is safe and a stock is risky, because that's not true anymore. The changing of the portfolios that we've had, a 30-year bond has a duration of 24. It is much more risky than some of the equity funds that we have, or hedge funds. So it's an archaic way of looking at risk. And so hopefully that the legislature will pass that, and we'll be able to implement a policy that looks risk in a more accurate and up-to-date way of looking at things.
Mr. Treasurer, if I may, just a couple of questions. One, and I don't know if you and I have talked about this, but I am very adverse to the State Loan and Investment Board setting on its own the risk parameter for the portfolio. I think it's a great place for us to advise, but clearly the return that the legislature is expecting is related to the risk that's there, and they need to be aware of what that risk is and weigh in on it, in my view. Mr. Treasurer, I don't know if you have a thought on that.
Yeah, yes, Mr. Chairman, Mr. Governor, we have, and in the process of explaining that this reference portfolio, the 70-30, we've made it clear, as Patrick has said, that the way that the legislature provides for that, it's a constitutional provision that they determine the risk, and they give us that direction about what that risk shall be. And the formulation has normally been in the understanding that equities are risky and bonds are safe. And in this particular low interest rate environment, the risk of interest rates going up on bonds and driving their price down is from the probability standpoint is probably more likely than it is of it going the other way. So it makes the bonds a statutory directive to say that you must have 30% fixed income, makes it problematic in managing risk and managing return. So the reference portfolio was explained in that context, in the context in which Patrick alluded to, and that full well that they knew that they were setting risk when they looked at their reference portfolio. And what we have done is kind of take a page out of the budgeting process in the legislature, where when a bill passes one house, it's profiled on the goldenrod. Well, this has passed the Senate, it's over in the House. And so these asset allocations that we bring forward are based on the reference portfolio, and getting in a little into the weeds, I believe it's a standard deviation of 1183. We did not go up to that. We left a lot of risk on the table, so to speak, as far as the IFC, not wanting to go to the maximum of that. There were some people that thought that we should go, bang right up to 1183 to 12, and that did not prevail. You've got more people in the IFC that are more conservative than going down that track. So I think we have a measured approach in the asset allocation to look at yield and to look at risk and to look at return, and to do so in a prudent manner, Mr. Chairman.
Well, thank you, Mr. Treasurer, and thank you for explaining that. I agree with you that the reference portfolio is the proper way to go. The biggest concern I had, and I maybe misheard CIO Fleming, but I was concerned that his comment was, "We'll set the risk," and I think that's clearly a shared objective. So thank you for that. The other question I guess I had, and I don't know, Patrick, if you want to speak to it, and Becky may, but it is disconcerting to me what Powell and Yellen both said recently, where they said we have the tools to deal with inflation. The tool they have is to raise interest rates, but their ability to raise interest rates at the debt that we are carrying as a nation, I would argue, is because they can't, we can't raise those interest rates to 18% or whatever it was during the 80s to stem inflation. And so I guess I'm trying to figure out, mathematically, I understand that, you raise interest rates to reduce money supply, but I guess, do we have any better information on really what the limits to that are?
Mr. Chairman, that is spot on. The conundrum that I think the Fed faces right now. I personally believe they've painted themselves into a little box. So let's just look at the numbers. Right now, the US government, this is before the 1.9 trillion stimulus package. The CBO estimates that the annual net interest payment that the government needs to pay is approximately $345 billion. For every 1% increase in interest rates, that number goes up by $240 billion. So if you had just a 3% rise in interest rates, the net annual payment that the government would produce would be the number one outlay that we would have. And so what people are saying is that your comment of we have the tools, the other tool that they have is just to buy every bond out there and keep rates from going up. And some people believe that they will do that. But if that happens, as you know, then we're on the verge of the Venezuela, Zimbabwe, Weimar Republic, which we've gone over every single way, and this has been a major discussion, but the one escape valve for that would be higher interest rates and a weaker dollar. I just don't see any way around it. With this type of debt to GDP level that we're having, as a government that is printing in your own currency, we don't have the risk of default, but we do have the risk for higher interest rates and a weaker dollar. And one last thing, Mr. Chairman, I do want to comment about the risk part, and Becky will get into this, but if you look at our IPS, we do set the amount of risk that is tolerated within the portfolio. So that's what I was alluding to. So in each different permanent mineral trust, common school, what have you, we have a risk tolerance, which I would argue that what we're doing, we would not change that risk tolerance. But right now, for instance, in the portfolio, it would be total portfolio risk should be managed with a goal of avoiding annual losses greater than 22% with a 99% confidence level, utilizing the appropriate statistical modeling. So what RVK does is they have these Monte Carlo simulations, and Becky can get into it and explain, if you care, about the thousands of iterations that they do that would keep that portfolio within that guideline. So no matter what the legislature provides, we could still keep that criteria for each one of our funds to keep it at that level, to make sure that we're still within the guidelines. But it's just, the only concern that I have is if we're able to move the variation of the assets that we purchase to still be within that guideline, that would then allow us to have a greater return. And so that's what the comment of the Slib board setting the risk.
Thank you. So, Mr. Treasurer, back to you.
Yeah, Mr. Chairman, thank you. Becky, I guess you're on, and we'll sit back and enjoy the presentation.
Okay, thank you, Treasurer Meyer, Mr. Chairman. Jake Dara from my team has joined us, and with your permission, we'd like to share our slides on the screen, if you please. Would that be helpful?
Absolutely.
Great. So Jake, you can go ahead and share. And for those of you that have the materials on your screen or in front of you, you can go ahead and turn to the page 3 of this presentation. Patrick has done a terrific job of just being able to kick off this conversation, and also all the conversations on risk are absolutely appropriate. So as we get this slide up, we'll go ahead and start. Jake, it looks like we've got your screen, but not the presentation so far. Let's go ahead and move to page 3. As I mentioned, it was a tough job doing the capital market assumptions process this time around. It always is, but in this particular year, for all of the reasons that Patrick mentioned, inflation, when we started looking at that, that's one of the central worries today in the market environment. We really had to look at that very, very closely to determine if we had a reason to move from this long-term 2% level. Just 1 second on the slide. So Jake, if you can't share, Lisa can take over and share her screen.
Oh, you can't? Can you see my screen but not the slides?
Yes.
Is that?
Looks like you may have to switch screens that you're looking at. If not, no worries. Lisa can pop over and do it for us. Oh, there we go. All right. Okay, no problem. Thank you, Jake. So back on the previous page 3, inflation was a really tough one for us. In fact, if any of you would like to read it, we have a very long white paper that we write every year on our capital market assumptions. It explains the thought process and the data that we use to come to the conclusions that we have. And one of the tough things on inflation, and we'll go through this in a little bit more detail, is that there is a lot of inflationary components that we're evaluating, some of the things we've already talked about already in this call. There are some offsetting conditions that are interesting to look at right now. So there's a lot of money supply, but money velocity has actually not been moving. So for when this liquidity has been provided into the market, not all of it is being used. If it were being used to a greater extent, we would see some more inflationary pressures, and that's just one indication. So we'll go to the components of what went behind this assumption going forward, but we did assume that inflation would stay at around 2%. It will vary up or down by a factor. So we're not saying it's going to be 2% in every period. We think it's very likely that the next period we're going into could vary from that. But if we look at a very long-term planning horizon, which is appropriate for most of the funds we're going to be discussing today, that long-term view is most appropriate for planning purposes. So again, we'll come back to this. The other thing that Patrick set up very well is that most equity investments are trading at very high valuations. And that is one of the factors that goes into assumptions, along with things like what's happening with dividends. And of course, inflation is factored into that model as well. So we had to look at where prices were for nearly every kind of equity and reduce that assumed return going forward. Now, when we were sitting in these chairs a year ago, and when we were in the depths of the crisis, the COVID crisis, we actually looked at our assumptions and thought that with that more than 30% correction in the US stock market, that we would have to look forward and say we expect to have the markets recover. And they did in historic fashion. And that is the issue. And the backdrop here is as we look towards the long term, we are more expecting some more moderate returns going forward because we have received that recovery very quickly on the back of many things, including the support from the Fed. And as Patrick also eloquently discussed at the bottom point, low yields. We're at historic low levels on yields, especially on the short end of maturities. And that's because the Fed has those short-term maturities locked at, in essence, zero. Now, we've seen the markets responding to concerns about inflation. And it has been one article I read said there was really a parabolic kind of relationship between what had been happening for little longer term securities as the market has tried to look forward and ask the question, will there be inflation? But, you know, as we still look, even in the context of where rates are on the 10-year Treasury, the 5-year Treasury, and then of course zero for those shorter term issues, we have to be realistic in saying that most of bonds returns are the yield. And that we're not set up for a falling interest rate environment, we're actually set up for a rising rate environment. And that will eat into that yield. So, you know, when you look at the assumed return for regular investment grade fixed income, if you subtract inflation from it of 2%, we're expecting basically zero in real returns from bonds. So that is just a quick backdrop. We'll get into more detail on the following page 4. Sometimes a picture really is worth 1,000 words. At the top of the page, we show you in these various colors the historical range of the 20-year annualized return for these asset classes. And then the dot is our current long-term assumptions. And when you look at that, we're actually saying that, yeah, it's towards the lower end of the range for most asset classes, including what we think inflation's growth will be. And if we look at the bottom of the page, when you look at the range of returns that we have created over the years versus our current expectations, same kind of paradigm, you look at all those colors, blue for equities, green for bonds, orange for other asset classes, and then brown for inflation, you can see that our assumptions are at the very low end of assumptions that we've created. And you say, well, how can you be so pessimistic? Well, I don't want to say we're pessimistic, we're being realistic for planning purposes and not telling the fiduciaries that we work with that they can expect the current world to continue with exceptionally good returns in equities. And, you know, the other thing that we have to be realistic about is that interest rates came down for a period of more than 30 years. We've been waiting for them to get back to normal, have been since the whole decade, since the global financial crisis. And it appears that we're going to continue with low rates for the foreseeable future. If you look at page 5, this is showing compound return assumptions now that RBK has generated. The same kind of color coding scheme is operative here in blue, equity, green, fixed income, and alternatives in orange. And when we look at the compound returns, and these are the kinds of returns you can expect over time, not this more simplistic arithmetic returns that sometimes investors speak to, but these are the returns that you can expect after experiencing risk and variability in the return streams over the future. And when you look at this towards the left, you know, the best expected performing asset class is emerging equity, emerging markets, international equity. There's a lot of reasons for that we'll go into, but that's some of the things that you can guess. You know, certainly demographics are behind the movement in those economies. They aren't as expensive as domestic equity. There's a lot of growth factors here that we expect in emerging markets. Next to it is private equity. By taking liquidity risk and choosing to lock up investments for a period of time, this actually we think will pay off for investors. And then deciding to put money in international equity, having higher dividend yields than the US, and as well as not being so expensive, we expect over the long term better returns there. There's a slug of asset classes that we expect about a 5% return from, including core real estate through the US equity markets, high yield fixed income, a little bit less than that. Hedge fund of funds is in orange. It's really a combination of a lot of different strategies, and we think they're good for diversification, but they're not the highest returning option we have here or tool. Then you can see to my comment about the US aggregate fixed income market in green, and then the expected inflation, in essence, a 0% real return for being in just investment grade bonds. And finally, TIPS, Treasury inflation protected securities on the right. So, you know, we have good tools in our toolbox to build a portfolio. It's just that the expected return for many of them is pretty modest right now. Does that mean we completely change our asset allocation? No. It does mean that we need to look for opportunities to improve our portfolio if we can, as well as be responsive to the risk preferences that are expressed for portfolios. The next page 6 looks at the building blocks that we use in building assumptions. Yes.
Can I ask you one question on the private?
Sure.
Equity? Is that assuming a new private equity portfolio or an existing one that has multiple years, multiple vintage years in it? In other words, performance of an existing private equity portfolio versus adding new?
Mr. Chairman, actually, that's a great question. Because you've been investing in private equity for many years, you do have a portfolio that isn't brand new and isn't going to be as subject to a new investor that said, I want to be in private equity now, and I'm going to pile in when markets are expensive. You know, they would stand the risk of being exposed to the relatively high prices we see in some private equity markets today, because so many investors are still trying to get in or trying to increase their allocation to private equity. So it's more of a what do we expect going forward, assuming that you aren't just piling into private equity in the current environment? Great question.
Thank you.
You bet. Page 6 looks at the building blocks for many of our asset classes when we build these capital market assumptions. And per Patrick's comment, this is a whole firm effort. We actually have a capital markets team that guides the effort, but all the investment professionals are involved in this process because it's so hard, because we need all hands on deck, and we need all outlooks on deck, and we also need the view of our clients' needs, helping inform what kinds of asset classes we provide expected returns for. So in general, when you boil it down to the elements on the building block methodology, it's pretty simple. We're looking at what income the asset class provides. That is coupon for fixed income, it's dividends for equity. Then we add inflation to it. It affects every single asset class assumption that we have. Then we look at the real growth that that particular asset may experience, and then whether it's cheap or expensive. How will valuations change? And so you can see some of those components for all the traditional asset classes. For example, public equity is income plus inflation plus real GDP and earnings growth, and then affected by whether it's currently cheap or expensive, and what do we think that will likely be in the future. When you look at fixed income, you're looking at coupon or income. You're looking at spreads. That's what OAS means, is option adjusted spread. And then expected interest rate changes in duration impact. So these models have a number of factors depending on the asset class, but they use this basic methodology. For others, for example, private credit is a strategy we'll be talking about, as well as private equity. We tend to look at the public markets and then build in a return premium for illiquidity as well as the risk of those investments. So for private credit, it's the bank loan assumption, which is private lending, or bank loans specifically, so you're taking credit risk, and then you're adding to that a return premium. Private equity, it's the public equity markets plus illiquidity and risk premium. And there's some asset classes that really are a hybrid of other strategies, and we've got those listed before. These don't necessarily affect your portfolio, but for smaller investors that can't be in as many bespoke asset classes and strategies that you are, sometimes they do look at these diversified asset blends, and we have a methodology for building up those assumptions. So to give a little color on page 7, we actually show you the snapshot of just the return categories for public US equity, the nominal return, which includes inflation, so that's a total return profile. And then we look at risk. All this is at the top. And what you can really take away, since you've seen the assumed return for large cap US equity and broad US equity, and small cap, and broad is just the combination of both, is that when you look at the 1-year change in the right-hand side in the upper section of page 7, you can see that returns have gone down a lot as we look at assumptions going forward, because current returns have been so generous in the recovery from the COVID crisis. When you look at the scatter plot on the left-hand side, this is a really interesting chart. It's only one factor that we look at in addition to the building block methodology that I just covered. But one thing that this chart shows you is if you look at what happened in various market environments in the past, 10-year real returns, when you look at the relationship between that return stream and what the starting price was for earnings in the beginning, it forms a relationship that tells you that there's some kind of rigor in analyzing this relationship between the starting price of equities and your eventual return. The different colors represent different decades or different periods. As you see, some are different lengths. As you look at these particular environments, you can see that we've got in blue what happened in 1990 through 2009. We've got in green what happened in 70 through 1989. And what you should note is that when we look at the current price of equities, it's going in price. So this is the number you should focus on in the horizontal axis. The going in price is 33.8. If you look at where 33.8 would fall on this chart, it would be towards the right-hand side of this chart and just under the 0 line. What does that mean? That means that if you use this one factor, you would say that the forward 10-year real return for equities could be 2% minus 0.8. Now that's one factor. It's just a dose of reality. There are some investors that say, just like was said in the tech wreck, just before the tech wreck, at the end of the 90s and early 2000s, this time it's different. Well, that's kind of a dangerous thing to always assume that this time it's different, because it seems like history has a way of pulling us back. And this particular, very dire US equity return may be a little shocking to you. We know that we can be in a different environment because of innovation and many other things, globalization. But when we look at this, it has to be one of the factors we look at. And that's one of the reasons when we looked at assumed returns for equities in the US, we actually lowered returns once again, is the effect of the building block methodology, the current prices, and then what history has shown us. Now, the next page is international. Got a little bit different information here in terms of graphs. And, basically the message is here, we did reduce returns here as you look in the upper right-hand section, just like we did for the US, but they started from a higher point because the assumed return for international equities has exceeded the expected returns for US equities for a while in our models. But the going in price is just not as expensive as you see on the charts in the left-hand side of this chart. If you look at the developed world, which is EFA, and then if you look at emerging markets for EFA, you can see that the current price in blue, that dark blue, is kind of to the left of the observations of history. And so that gives us some comfort that, the going in price isn't as rich. And emerging markets, it's even to the left of that peak point of the bell curve. So a little bit more normal prices for emerging markets. And we had a little bit more modest assumption of mean reversion, if you will, for that asset class. But overall, we still think that returns are productive, especially for emerging markets, and hence its position is one of the better expected asset classes from a return perspective going forward. On the following page, fixed income is highlighted on page 9. Again, upper right-hand corner shows you the return direction relative to the previous set of assumptions. So all down because interest rates are low, and most of fixed income return is really based on coupon expectations, especially when you look at the historical graph on the left-hand side. What we've got here is a number of 10-year periods, forward 10-year periods. It kind of works like the equity chart. But you'll notice when we look at where the current yield to worst is, those yields are really indicating a return of about 1.6% for fixed income going forward. And that's in nominal terms, not real terms. So this is showing us that basically look how close those observations are between the going in yield before these 10-year periods and where returns actually ended up. There's a tight relationship, much tighter than equities on the chart below, and that most of the return is really explained by the going in yield. And if you had to plot where that 1.63% is on this chart, go to the left-hand side of the black line and keep going down in a slope similar to the line, and you'll be kind of out there in space below some of the historic expectations. So this, again, is just one factor that we used in coming up with our return for fixed income. It just seemed that there was a lot of weight pulling down that expected return based on the going in yields are so low. Inflation is on the following page, and this is probably one of the most controversial. Obviously, as I mentioned, we're looking forward. We don't see any factors over a 20-year period that would tell us that we're in for an extreme inflation environment. But, there are factors in the shorter term that could affect the actual level of inflation that we see. We're actually assuming a return of 2%. In the upper right-hand section of this page, you can see there's just dashed lines for the 1-year adjustment. There is no adjustment. The other thing I'd call your attention to is that US inflation, we're assuming is 2% over a 10 to 20 year or longer period with a risk of 1.5. That means that 2/3 of the time we expect inflation to be 2% plus or minus 1.5. In other words, 3.5 to 50 basis points. So there is some room here for movement in inflation, but the long-term trend is centering around 2. And one of the reasons that I pointed out in the beginning of my comments that we looked at inflation so hard is obviously the stimulus that we have seen coming into the markets, as was talked about in the beginning of our meeting today. I also implied that we'd seen some factors that were kind of heading the other direction that were more disinflationary. And when you look at that, the chart on the left-hand side with the green and the blue lines is showing you the money supply, which is what we're all watching. And with the most recent stimulus bill, again, is heading up even further. The supply of money has been quite dramatically strong, large, if you will, especially if you look towards the right-hand side of this graph. If you look at the green, that's the velocity. How often is that money that's been put in the system, how often is it trading hands? It's not as often as historically normal. And you can see that green line is heading down. So that's one of the things that certainly is affecting our inflation outlook. The implied expected inflation, when you look at the TIPS market, is at the bottom of this page. And that's all centering on 2%, even out to 30 years. Now, we know that is very much impacted by what's going on in fiscal or monetary policy and what's happening with Treasury yields, especially on the short end. But again, here's just a couple factors that went into our process. So, the punchline on assumptions is on page 11. When you plot all the asset classes on a line, and we do have a lot of rigor in putting our assumptions together for every single asset class. But we do make sure that our assumption set hangs together, that it makes sense, that investors have realistic choices between, depending on their risk budget, how much they want to put in every asset class. The asset classes have to be related to each other. When you look at this, the yellow dotted relationship is where the capital markets line was if you look at risk horizontally and return vertically, where it was for the last set of assumptions that we came up with in the early part of last year, just right after the COVID crisis hit. It actually had a better relationship between return and risk. Now that we've gotten such a huge recovery in risk assets, in equity assets since that time, in just a 9-month period of time, we're sitting here looking at this and saying, well, we got a lot of that future improvement already in these asset classes. And so the relationship is that the asset classes are providing less return for the volatility we're expecting. So this is, again, all based on assumptions. There's many different acronyms here on this page for asset classes. You can see that they vary dramatically one to another. But when we look at the general relationships of the opportunity set of what your toolbox looks like, the hammer, the screwdriver, the wrench, as you look at each one of those pieces, they're lining up to be helpful to build a portfolio, but have more volatility for the return they're expected to deliver, which is lower than expected. Page 12 is not meant to review in any specific detail, but just to show you, these are the primary capital market assumptions that we set. On the left-hand side is the assumptions that were set at the same time last year. And then the next set of assumptions, just to the right of center, is the update that we did provide when we saw the big market correction, and then tried to look forward at that point. And now today, the difference between the 2021 assumptions, 2021's on the left-hand side, and then the most recent set of assumptions prior to that is just to the right of it. The adjustment is on the right-hand side. This is the 1-year adjustment, moving from the previous set of assumptions to the current assumptions. You can see the difference columns are showing negative for the most part. Most asset classes did get a haircut in assumed return, with a few exceptions. Real estate, for many reasons, the yields in real estate still look attractive, and infrastructure is something that has been introduced as a new asset class and we'll discuss that today. No change in cash, no change in inflation assumptions. So these are some important inputs that go into the model. And another set of important assumptions, especially for Wyoming and our spending needs, is on page 13. What are the estimated asset class yields? And because many dividend yield expectations and observations, as well as fixed income yields, are down, so those are reflected in our modeling, because we do provide a yield assumption or a yield observation expectation going forward, so you can judge. There are some asset classes, though, on the right-hand side in the 1-year adjustment that actually show some positive trends, and that is the yield on MLPs, preferred stock, and non-core real estate. So yields are going down with the exception of a few asset classes.
Becky?
Yes.
A quick question, just on the capital market assumptions page, and Mr. Treasurer, I guess really the question's for you. Did the IFC have any disagreement with the market assumptions or questions, or did they generally agree where that was? Just curious.
I would say, Mr. Chairman, generally agree as far as the returns going down. Generally agreeing, as Patrick alluded to, that it's a lot tougher to get the yields and returns that we have in the past.
Yeah, and I would agree with that. You know, and Becky, I mean, you and I know each other, so you know this isn't a questioning of the value. Just there's lots of different opinions on how to arrive at market assumptions. So I just was asking about that. So
yeah, absolutely appreciate the question, Mr. Chairman. And you're right, there are a lot of different ways to come out this, and generally we don't think returns are necessarily, or that the asset class assumption process should be, you know, different, or that we need to kind of take valuation off the table and say that things will continue to become more expensive. I guess the positive part is if we're wrong and returns are better in the marketplace, we're all better off. We'd much rather be more middle of the road, not be overly pessimistic and have much lower expected return from risk assets. But we don't serve anyone well if we come in being so optimistic that portfolios are not constructed appropriately and seeking return in a lot of different areas. So.
right, and I agree. I guess the one question I have, when we have a rosy view, which we've had for some time about emerging markets,
mm-hmm.
and they haven't really come home that way. That was really kind of where that question was centered.
Understand, Mr. Chairman. Yes, it's been, you know, emerging markets we are very constructive on over a long period of time. I think that, you know, the conversation on emerging markets has gotten interesting because you can have a conversation about China, you can have a conversation about Argentina and Russia, and they can be very different, or India. And so there's tremendous diversification of what their revenue sources are, what their exposures are, that make it a very not homogeneous type of, they're very heterogeneous right now, markets and economies. One thing they do have in common is certainly the demographic wave that's expected in many of those economies that we think will push economic development. One thing they do have in common also is that when the markets are scared, that is where they take the risk off the table.
Yeah.
Those risky assets correct more than anything else, not for any specific reason that they're impacted by. It's just investor sentiment. And that is definitely some of the things that we saw during the COVID crisis. And then we've seen, recently much better performance, but it's a rocky ride to get the benefit. So, looking at emerging markets, it's something that has a lot of qualifications to it in terms of being able to have that exposure in your portfolio, but not overly bet. Because if you do, then you are adding risk to the portfolio, and especially risk during downturns.
Yeah. Thank you.
You bet.
Yeah, Mr. Chairman, and I think that one of the things that we're going to continue to do is try to get the absolutely top best in class managers. So when these things occur, and we know that they are going to occur, these corrections in different areas, that we have the best managers to hopefully not take the hit that the whole market presents, and actually outperform our peers in that regard. So I think that Patrick has put together an exceptional process in manager selection, and we're gonna continue that due diligence.
Absolutely agree, Mr. Treasurer. So page 14 is the last assumption. I know I've taken a lot of time on assumptions, but as all of you know, when you're working with numbers, when you're working with a mathematical model, you need to understand what the inputs are to be able to take conclusions from those models. So the rest of the presentation, I will be picking up speed a little bit and always pausing for your questions. Before we go to the rest of the presentation, though, page 14 is really important. One of the things that all of our risk models show us for most investors is that the most risk that they're exposed to is really coming from equities. And it's coming from a lot of different asset classes, but the thing that tends to drive results overall is the risk inherent in equities. So when we look at the various tools that you could use in asset allocation for your various pools, both the income and growth oriented, as well as all the others, it's important to understand how these various flavors of investing behave relative to equities. Because at the end of the day, you can think that you've been diversified in your portfolio by combining equities from every source. And at the end of the day, when you get an equity correction in the US, you're hit by it. You don't have anything that behaved tremendously differently. And so this chart is just showing you, if you look at the first column, US equity and the correlation of how other investments move with US equities. And the good news is, green is the asset classes that are all pretty closely related to each other, and there's not as much diversification opportunity. There may be other reasons to invest, such as return. In yellow are asset classes that do have lower correlation with equities. And the good news is that's your fixed income investments, that's your real estate investments, that's your commodities. If clients have those, it's any custom fixed income like you have for workers' comp, for example. So when you look at building a mathematical asset allocation model, sometimes investors think, well, I just need to combine investments that don't behave like each other or negatively correlated. There's not many investments that are negatively correlated with the US equity market that are available for institutional investors. But there are investments that are yellow that have lower correlation, and then a few that are zero, like cash. But if you want to diversify the risk in your portfolio by holding cash, the risk today is you're not going to get any return. So that is usually not a tool we get to use very often or should use very often. So correlation is an input into our model. So changing the conversation now to looking at what other sovereign wealth funds are doing on page 16. You've seen some of this data before. We've also added to this on the left-hand side what endowments and foundations are doing. because that is a institutional investor group that tends to be used as a comparison point for sovereign wealth funds. Endowments and foundations have a spending policy that tends to be today in the education world, higher education, somewhere around 4.6. So it bears some resemblance. Other public foundations have to spend 5 every year. So we use this National Association of College and University Business Officers survey on the left-hand side, the funds that are greater than $1 billion, just as an interesting point. Other sovereign wealth funds are noted here horizontally with the percentage that they participate in basic asset classes, as you see here. And one of the things that you'll note here is that about, let's see, half a dozen of these plans actually have 80% of their investments or more in risk assets. When you look at where Wyoming is, we're towards the right-hand side. We have something closer to 65% in risk assets in the case of the Permanent Mineral Trust Fund. And then in the case of Common School, you can see it's in the mid-40s. So there are certain other sovereign wealth funds. I've noted about 6 of them on the left-hand side from Texas, or 5 of them from Texas, Permanent School Fund to the University Fund, that have 80% or more in risk assets. Again, they haven't been constrained by an ability to invest in risk assets like the 70% level we have here. And then NACUBO is not really restricted at all with risk assets of about 90%. So this is something we looked at. You can look at the composition of the asset classes that we have versus others. You know, looking at US equity in green, certainly there are a few that have a very high participate in US equity specifically. If you look at the combination of green and blue, you can see their total equity exposure. And some like Idaho mostly have equity, as you can see, at a high level in few other asset classes. So there's quite a difference in terms of composition here, but if you look at that level of risk assets that they hold compared to where we are today, certainly many do have a greater risk asset participation. When we look at the allocations on page 17 to risk asset classes, other investments and what trends have been, relative to US equity, we see that the trend year over year from 2018 to 2020 is that we find in this survey that we're seeing US equity allocations go down, non-US stay pretty much the same, fixed income coming down, expect to see that again next time we update this. And some things going up like real assets, like hedge funds, private equity, private credit, a big one. It wasn't included in a previous survey, but a lot of investors were not participating earlier. So we have seen allocations to diversifying and return-seeking investments moving up over time. On page 18, we show an expected risk return for every sovereign wealth fund that we plotted on the previous page, as well as NACUBO. And we put this against the backdrop of an efficient frontier, asking our asset allocation software to use all of these investments and mix them in a way that's diversified and diversified in trying to provide the most effective risk and return trade-off. And when you look at where Wyoming is in specifically the Permanent Mineral Trust Fund in the green box and the blue box, the Common School Fund, you can see generally we're the Permanent Mineral Fund is towards the middle of where the efficient frontier is, having a moderate level of expected return and risk for its composition as we look forward. Using our capital market assumptions, Common School is to the left of that. It has, again, an income focus, but you can see where the other sovereign wealth funds are. We're going to plot with the IFC's proposed investment portfolios for these two funds, what this would look like if we were to move forward with that proposal. But the punchline is it would move up both the Common School and the Permanent Mineral trust fund up and to the right and more towards the grouping of other sovereign wealth funds, not because they all know the right thing to do, but because if we look at our overall needs and the market conditions, that's the right direction we believe to move. So speaking of surveys, we'll move to that section on page 20. So on page 20, we have got a survey that was conducted of the IFC members, your investment staff, the Treasurer'S staff, as well as your RVK staff. I participated in that, and so did your other RVK team members. And we basically asked the question, how interested are each of the participants in pursuing investments in these asset classes going forward for the Permanent Mineral Trust Fund. And in purple is RVK, and red is the investment team, the yellow is the IFC average. And one of the things that you can note is if you look at the horizontal line at 2, an answer of 2, that means that the allocation should remain the same. And then when you look at where the bars and colors are grouped, if it's below that line, there's a general sentiment to reduce that kind of investment. If most of the observations or participants are above that line and saying there's an interest in increasing it. When you look at a few of these asset classes, you can see there seems to be some interest, although there's a big range of IFC responses here. In private equity, perhaps increasing that. There's some support for small cap. There seems to be support for increasing non-US equity. Broad market US, that's just looking at large cap and small cap altogether in US. There's some support for that. Hedge funds, basically all market participants agreed to at least be where we are or a greater allocation. There was quite a bit of support for real estate in general. When you look though at the asset class where there was pretty much uniform agreement, it really was reducing core fixed income per Patrick's comments in the beginning of our conversation today. So hopefully that's not a big surprise, but based on where yields are, that was generally the observations of all these survey participants. When we looked at page 21, what else can we do other than the asset classes we just reviewed? If you look at, again, answer of number 2 is moderately interested in adding to the portfolio. 0 is run the other way as fast as you can. And 4 is very interested. You can see that there certainly was some interest, more interest in the infrastructure and private credit. And then, kind of mixed interest in some of the other strategies. Non-core infrastructure was of interest. Direct lending is what's meant by the SSDL, senior secured direct lending. That's a form of private credit. There was interest there. So, there was interest in pursuing some other asset classes to help our portfolios moving forward. Another question that was asked is, oh, was there a question?
Yeah, one quick question on infrastructure. Sure. Just
yes.
What are we talking about specifically? Airports, that sort of thing?
Yes, and there's quite a range of things that can be grouped as infrastructure, but basically the characteristics are assets have a long useful life. They have high barriers to entry. They're somewhat monopolistic or quasi-monopolistic. They're a regulated environment. They're capital intensive, but they're somewhat resistant to business cycles. They have cash flows that are stable and can respond to inflationary periods. And they're hard to replicate assets like the examples you just gave. And then there's various ways to invest in infrastructure. It can be through the private worlds. It can be through the public world. There are public infrastructure equities. There's open-end and closed-end funds. But generally what we mean by infrastructure is that very large basket. Does that help, Mr. Chairman? Okay, great.
Yep.
All right, so as we look at thematic exposures, kind of backing up now out of the weeds of looking at various asset classes in specific, what thematic exposures did these survey participants say we should emphasize? And when you look at this and where the colors are grouped, there's a big consensus that capital appreciation needs to be a big component of our portfolio. We need the long-term growth for intergenerational equity. We know we need to generate income as well. That's a key focus. But capital appreciation is something that we all agreed on was very important to at least 40% or more of the portfolio. Capital preservation needs to be there, obviously, but a smaller portion of the portfolio. Inflationary related asset classes is another tool that we all agree these are long-term assets. Inflation affects the ability of our funds to meet their obligations in the long term, and preserving purchasing power is important. And then finally, strategies that are there to produce returns without being dependent on just one market is what we call alpha. And there's pretty significant interest there. There's different opinions in terms of how much, whether it's 10%, 15, 18% or more, but certainly that is important. But the big takeaway from this is we know that the capital appreciation is where the bulk of our portfolio will need to be, at least a significant portion. And liquidity, how much illiquidity should we think about as we build portfolios? And there was, if you look at the IFC average and the participants, it's somewhere, around that 30% range. This is not dissimilar from other long-term portfolios. When they look at pursuing a diversified portfolio, have a spending requirement, but really need growth over the long term. It really is a recognition that the illiquid markets are one source of that exceptional return relative to just traditional asset classes. So very interesting on page 24, when we look on a scale of 0 to 4, with 4 being extremely concerned, how concerned are folks about these various risk factors? And one of the things when you look at this chart, people seem to be concerned about the opportunity cost of not participating fully in the markets that we need to participate in. We're concerned about what's going on with interest rates. Equity risk and valuations are of general concern. And inflation is something we've got to keep our eye on. Certainly, there's a number of other factors like spread widening or concerns about investments that are correlated to energy. Liquidity seems to be a pretty low concern for most. There were, again, some outliers there. Sequence risk is just what happens in the near term. For example, you adopt a new investment program and you do bear the sequence risk of immediate market falls right in the near term versus just along the path of the future. Dollar strength is something that we asked about, and deflation. So this was kind of an interesting backdrop to see what was on folks' mind. Page 25 is an interesting question that has come up at the IFC. And for many investors, they just wonder, asset class detail as detailed in your investment policy, what level of detail is appropriate. I won't spend a lot of time on this particular chart, but it's kind of interesting to note that certainly there seems to be a lot of support for a fair amount of detail in your investment policy going forward, and the ability to model investment portfolios and their expected results. And so certainly I would say that the review we're doing today is consistent with somewhere between the moderately detailed and highly detailed. You have so many asset classes you participate in. If you included every small nuance in there, it would be very hard to model and very hard to make decisions. And yet we believe you have enough detail to get a real handle on where your investments could potentially be. That's a lot of pages. We're all the way to page 27 now. Are there any questions before we move on?
Yeah, I had one quick question. I don't mean to dominate this, but when we talk about capital appreciation, and you've been around the state for a long time, so has Treasurer Myers, so has Secretary Buchanan, and may have participated in some of those discussions about what to do with capital gains. Mm-hmm. I guess the question I have, normally when you're thinking about capital appreciation, you're talking about being able to plow back to a degree, some of the returns to help with appreciation. In Wyoming's case, we have some limits on that, as you know. Does that affect, and I guess the question for you is, has that affected how we've dealt with things for the state? And then I guess for Treasurer Meyer, does the IFC understand that you know, the state plans to spend every bit of capital gains it ever gets? What annoyingly so.
Mr. Chairman, I think they're beginning to understand that, Mr. Chairman, that it's hard to take any of the reserves and have them end back in the corpus for generational equity or for an increase in the overall amount of capital we can utilize to spin off yield. I think that the Senate understands it and is appreciative of that stance. I think the House has, I guess, different leadership characteristics that are unique to that chamber. So, you know, what we can and can't do, I guess, is just to continue to educate and hope that that people understand that there's some different ways of doing the business. There are some constitutional provisions about the definition of income that RBK has been working on, and some other areas of the Constitution that necessarily I think could use some discussion to move us more into an organization and give us more tools in the toolbox, so to speak, to provide the income necessary, but also provide for increasing the capital that we have to work with. And I know some states like New Mexico have a constitutional spending policy limit, and so they kind of mute their powers of their legislative process. I'm not sure if they have a 60-member board of directors for their investments, but I think that if they do, I think there are some guideposts that they can work within. And that's a discussion, Mr. Chairman, as you well know. It's an evolutionary process, and we're just continue to work through it. And so, it's not all perfect, but I think that if we can, if we could convince senators to run for the House, I think we'd be in better shape. Tongue in cheek, Mr. Chairman, I guess, on that one.
No, I just appreciate it. I'm just pointing out that I think it is, if your expectation is sort of based on total return, but you cut the legs out from total return, you're going to be disappointed. So,
yeah.
Right. On page 27, actually, to the point of, how are these funds actually structured, mindful of the things, Mr. Chairman, that you had mentioned, and Mr. Treasurer as well. We look at the overview of the investment funds and note the permanent funds. Those are listed. As you know, they're subject to a maximum of 70% invested in equities and alternatives. And you'll recall some of the other sovereign wealth funds that we looked at on that chart with a lot of colorful bars, is that, some of our brethren out there in the sovereign wealth land have 80% or more. So certainly we do have a cap, but that cap is so much better than what it has been in past years that has moved up over time. So we have some with a long-term return focus that are listed there, the permanent mineral being the biggest example or largest of those pools. An income focus, which is the common school and higher ed endowment. And then we have the workers' comp fund, which is a different animal, if you will, and a different structure. And then we have our non-permanent funds, Pool A, the state agency pool, and LISRA. That's just a reminder, nothing new for you here today. As you look at the following page, you can see the things that this group has been successful in doing as a partnership. These are the 2020 asset allocation enhancements that were made last time we went through this effort, and hats off to you all for the improvements made there. You can see what they were by return focus, so total return, increased international equity and decreased fixed income. So the changes that we're suggesting today are certainly not the first that have been made, but just an ongoing series of efforts to look at the forward expected environment and make adjustments in our portfolio to be positioned for that forward environment. You can see what the other changes were made here, but certainly, again, a significant amount of enhancements were made last year. We want to thank you for all the effort and the assistance in the meetings like this one that were held last year. Page 29 is just a generalization of how our sample permanent fund is here, the Wyoming permanent funds are versus endowments. That comparison is made pretty frequently, but there are some pretty important differences that I think you're all aware of. One is that, both types of investments, permanent funds and endowments, want to produce intergenerational equity. But in the case of spending of corpus or principal, we can't do that here with our permanent funds, and of course endowments, most have for that provision. We have a constraint on the total book value of non-fixed income and cash investments of 70%. There's typically not a limit on that in endowments and foundations. The revenue source or funding source is a little different here in Wyoming, but is common with a lot of sovereign wealth funds in terms of royalties, taxes, land revenues. Here in Wyoming, this is variable, but we expect it conservatively to be a smaller source of revenue in the future, whereas endowments are reliant on donations and their own efforts to get out there and try to get those commitments. And spending constraints, the endowment and foundation world is generally not limited to their spending and how it is done. I mentioned that 4% average spending rate that is implemented. That's based on just taking 4.6% of the total return and being able to sell assets to finance that spending every year, as opposed to our paradigm in Wyoming, which is income and capital gains. And then you can see the guaranteed spending levels that are listed at the bottom of the page. Those are just all for context, both on assumptions and how our limitations are in Wyoming in terms of spending, where we get that spending, what our maximum risk assets can be. And now we're ready to dive into the results of hours of deliberation with the IFC and the Treasurer's Office and RBK that we had a couple weeks ago, and a lot of preparation for that. So if you'd like to turn to page 31, Mr. Chairman, I don't know if you were planning or needing a break at any point, but feel free to call that if you'd like, and I'd be happy to keep going or entertain a pause if you'd prefer.
Let me poll the other members. Treasurer, what's your pleasure? And if you're not there, how about you, Auditor?
Okay for now, Mr. Chairman. So whatever the everybody else thinks.
Okay, Secretary? Can't hear you.
Like take 5?
You want to take 5?
Me too.
Okay, thank you, Becky. Let's take 5.
See you in 5, guys. Okay.
Get another cup of coffee, Treasurer Meyer?
Oh, some green tea.
Ah,
Yeah.
being good, staying off the caffeine, huh?
Well, I have my first cup of French press in the morning, and
Mhm.
after that, I kind of go the non-caffeine route if I'm going to get any sleep at all at night.
Yeah, I hear you.
Yeah. Of course, you're in coffee country up there. Yeah.
We are. Yeah, I start my day with French press as well. Sometimes I go to a second cup. Probably not a good idea.
My press is big enough. I get about a cup and a half out of it, so that'll do it. Yeah. I use the best coffee I can get out here for that is at Major Dickinson's. That works pretty well. I think Secretary Buchanan has some Dasbog blend that he's really into, right, Ed?
Oh,
Yeah.
nice.
KGB blend. I don't like the name, but it's good stuff.
Makes you wonder.
What is it called?
It's called KG blend, but Dasbog plays off of everything Russian, so
KGB, yeah.
KG blend, yes.
Don't want
But I
that to be a
highly
headline.
recommend it.
They actually have a sugar-free mocha there that I've tried that is okay,
Oh, wow.
Yeah, at Dasbog.
Any way to get chocolate, and if it's sugar-free, then I don't have to feel guilty about it.
There you go. Yeah, you got it. So I want to apologize for not taking a break. When I needed a break, I should have said, does anybody feel like a break?
Well, and time goes so fast for me, I just looked down and realized you have been listening to me talk for almost 90 minutes. It's time.
It's a lot better than listening to the legislature, though, I got to tell you.
Yeah.
All right.
Well, I see Superintendent and Secretary. I hear the Treasurer. I don't know if the auditor's on.
Yeah, Christie's here.
All right.
Ready to go?
I'm ready to go.
Let's
All
roll.
right. Okay, thank you so much. So we're on page 31. With all that buildup, we're going to go through the recommendations from the IFC on the following pages. So we're going to start with the total return focused plans. There are so many asset classes and details here. We thought a summary page with a change column on the right-hand side would be the right way to go through this with you. So at the top in blue are the asset classes, the current, the proposed, and then the change that the recommendations actually imply. And one thing you're going to notice on the total return focused plans is a 14% less allocation to traditional investment grade fixed income, consistent with all of the discussion that we had prior to this slide talking about the going in yield environment. So where do we put that 14% gained from lightening up that particular asset class? Adding to private equity, to private credit, that's significant at 5%. That particular exchange for aggregate fixed income investment grade US exposure for pursuing private markets to try to enhance yield and return is something that many investors have been doing or thinking about going forward as they deal with the low expected return and yield environment. The other portion of that 14% lighter allocation to fixed income going into non-core real estate. It's a good diversification opportunity as well as the opportunity to earn some yield and pursue return Private core infrastructure, per your questions, Mr. Chairman, Governor, earlier on about infrastructure, this is something that many investors are thinking about as another way to earn yield and pursue return. Also investments that tend to do well in an inflationary environment. And then finally, hedge funds, a statement that, you know, it's worthwhile increasing the allocation to products that can be flexible in where they're investing, trying to look for return, if you will, in many different places. So that's, you know, the big punchline here is lightening up significantly on fixed income and spreading that 14% out across many strategies. And the one fixed income related strategy, if you will, is private credit. What does that do? Well, if you look at the next set of information, this is really showing you that this, you know, if you look at the public equity and alternatives, and this is on a market value basis, this would push us to 73%, and your restriction is book value. And because you've had many investments with book value, that's going to be lower than that 70% max. But if everything were, you know, marked up to current value, that is something that we need to think about and review in terms of that 70% max. So that is a 9% increase in public equity and alternatives. You know, the various buckets or themes in the portfolio, growth, for example, the IFC through all of the details in blue is really saying we want to move from a 50% growth allocation to 58.5. So that's an 8% increase, reduce capital preservation by 14, and then increase alpha or hedge funds a little bit and increase inflationary related asset classes to 21%. So that's a 4% increase. So, you know, those are the basic themes of these changes. Again, all based on the observation that capital preservation is where the IFC wanted to lighten up allocations to pursue better return and growth going forward. What's that mean in terms of return? The information that's in the next section, return, standard deviation, and yield, focusing on both the IFC proposed and the change column. This means that the compound return expectation would move from 5.2 to 5.8. So that's about a 0.6% increase in long-term compound return, and yield would go up 37 basis points to 2.7. That's a pretty nice set of changes there to increase both expected return and yield. Risk does go up in the process, so let's look at risk. And let's look at the bottom of this page. We looked at a 1-year period of time and what's the worst case result we could expect in our Monte Carlo simulations that Patrick outlined at the beginning of his comments. We actually look at not just, you know, a bell-shaped curve that people talk about in asset allocation, that, you know, all your expected investment results kind of line up on a bell-shaped curve and it's perfectly symmetrical, and you're as equally likely to get returns below that median return as you are above. This is real world that actually looks at the fact that equities don't behave like that. They've got worst case markets that are worse than people actually expect if they go in thinking a bell-shaped curve. So when we actually build some reality into that downside market testing, one of the things we see here is relative to the current portfolio, that 1-year worst case result could be a little worse by about 1%. Again, that's 1 year. These funds are not invested for 1 year, they're invested into perpetuity. But it is something that all participants in this process needs to be conscious of and comfortable with, is to pursue additional return is in many cases to accept some additional risk. In this case, there is some additional risk on the downside of about 1%. But over a 10-year period of time, that 50th percentile or median expected return improves by about 0.7%. That's not a bad trade-off. And again, we'll review in a second some of the current policy language that has risk really discussed in your investment policy in terms of at the 99th percentile of confidence, what risk you need to be able to, or that you will comply with going forward, realizing that that is being contemplated for change in exchange for having a risk profile that's more like a benchmark, a 70-30 type of paradigm. So that is the summary of a lot of modeling, a lot of discussion. But this is the portfolio that the IFC wanted to bring to you today, that all of us, the Treasurer's Office and RVK, were collaborating on. Before we get to details, and I'd love to pause for your questions in just a moment, I just want to explain a couple of other things on the total return focused permanent funds. If you look on page 32, again, for those that would like and enhance all those numbers with a picture, this is a risk return graph, expected risk return in this case, looking at risk horizontally, return vertically. That set of 10 green portfolios are the output of our model, which I'll show you in just a moment. What this is showing you is actually where the current total return portfolio is, where the permanent mineral trust fund is plotted relative to that set of potential opportunities. It's somewhere between portfolio 4 and 5. The IFC's discussions really focused on something between 6 and 8, and actually came up with the blue portfolio, the total return focus proposed, that's near portfolio 7. And note where the 70-30 portfolio is. So, in talking about judging risk or setting risk relative to a 70-30 portfolio on an expectations basis, this proposal is falling below, as Patrick mentioned, that 70-30 benchmark. And that's down and to the right. And that's, again, due to the diversification that's built into the proposed portfolio.
Becky, and I'm trying to figure out how to express this. My concern is that not all risk is alike. Mm-hmm. And so with equity risk, we know that there is possibility of capital destruction.
Yes.
Absolute. With fixed income, it's more like erosion rather than destruction.
Yes. Mm-hmm.
And I just want to keep that perspective in mind, because I think, people often think that, we're going to go out on the risk profile, get a better return, and markets. Certainly you can look back to 1900 and there's just no question that you're doing better on capital elements. But I guess I'm struggling with that, because I know most of the people on the IFC are investors, and mm-hmm. So risk is part of what you deal with. But for those of us that are charged with a fiduciary responsibility, if that's in fact the case, I guess I worry that you have a substantial downturn in the market, and suddenly people are going, well, where the hell did money go?
Yeah. No, I completely agree with you on many points, Mr. Chairman, that there are many different types of risks. I like your term erosion in the terms of fixed income discussions. And I think the newer paradigm today is, when we look forward at the capital market assumption for fixed income, we need fixed income. Even in the total return focused portfolios, we need it for capital preservation, which it tends to provide over the long term. The problem is that our return outlook for that asset class is the same as the expected growth in inflation. And if we find that returns don't live up to providing that same level of as inflation for fixed income, then erosion can happen, like you said, in real terms. So, but there are many different risks. We're trying to balance them. We're trying to balance liquidity risk, inflation risk. We're also balancing, actual hits to asset values that can happen, especially in equities in short periods. your private equity portfolio is faced with, illiquidity risk, but it's faced with individual private equity investment actual risk of principal, but over the long term tends to be held and diversified so much that even the risks that those portfolios experience tend to be, more like a traditional equity, even though you're taking more than traditional equity risk. So you're right. It is balancing all of those risks. And in the model, the way we accomplish this, and your point is right, that investors tend to get comfortable with the risks that they face every day. That's just part of our role in what we do. Whether it be an equity manager or a fixed income manager or someone in the real estate market or private equity markets. In the asset allocation, we're trying to blend a lot of different risks together and try to account for them. One is the risk of returns being variable, and that's really the risk you see in the horizontal axis of this page. We're controlling illiquidity risk by not only, this 70% constraint on not straying above that for anything but fixed income and cash investments. Liquidity risk is really balanced within the fact that we know you need to pay income and we know the metric by way that you do it. So the constraints we put on the model and how much you can have in real estate and infrastructure and private equity is actually a hard constraint we actually put on the model to accommodate that particular risk. So there's a number of risks, you're right, that we're trying to account for. And it isn't just the risk you see on this particular page. And I'm glad you brought that point out. There are other risks that we're trying to balance in some of the constraints we put on the model and in the choice of asset classes to talk about.
Okay, thank you.
All right.
And
So
Mr.
can
Chairman, go ahead, Ed.
I just was going to say, I'm glad the governor asked the question, and this is something I've wondered about. When you look at the equity asset classes we have listed here, now since I've been here, we've been told over and over again, and I see it in the market that it can't get any more expensive. It's overvalued. We're due for a correction. I mean, that's been 3 years consistent message. And as the governor noted, when things go south and that's not erosion. I mean, you lose.
Mm-hmm.
What's the discussion regarding equities? Are there other places we can go and lessen our risk in the equity class, or what's the backroom discussion that supports us not making a change as we see here?
I'll kind of explain that a little bit. Is that's essentially exactly what we did. We didn't pile into broad U.S. equities, small caps, broad international. Those all stayed the same. We didn't change in that definition of equity. And it goes into the definition of equity, where equity, as we have previously looked at it, was anything but fixed income. So real estate was determined to be equity in that definition. Emerging market debt would be equity, perhaps in that definition. So anything except fixed income was determined to be equity. So what we did do is that we went into more or less asset-backed based investments that, although defined as equity, they're actually collateralized in their underlying premise by real assets. So they're more of an erosion than lose the whole ball of wax type of a thing. And so, that's what we were looking at. And when you look at private credit, they have the ability to actually, they're a floating rate instrument. So as interest rates go up, their values necessarily don't depreciate or erode like stocks will. they're actually make adjustments to the interest rate within that period, as well do bank loans. So, and that's exactly what we did, is that we didn't double down on a lot of equities. We went into private equities, but those are going to have to be legged in because they're expensive. And that's something that both Becky and I think Patrick will discuss more in detail as far as the implementation after the rest of this. But I would say that where RBK put some hard caps on some different things, I think the folks that were more conservative on the IFC and from the Treasurer's office put some hard caps on how much we were going to take off the table as far as our fixed income, because there were certainly recommendations to get 100% out of fixed income. And we did not feel at all comfortable with that, you know, from the same perspective that I think that both you and the governor have, that it's necessary to have fixed income for a lot of different reasons. And that if we're going to have something other than fixed income, it was going to be something that had a higher yield, but did not basically perform like the stock market. And if you look at that heat chart that Becky brought up earlier, these were primarily things that were in the yellow boxes that were not correlated to U.S. equities. So that's kind of how we put this together, was to try to do the non-correlative ones, had higher income and variable income as interest rates went up.
Great. Treasurer Meyer, that was terrific. Thank you. Saved my voice. Terrific points, and it's exactly what was behind the deliberations.
Yeah, and I would say I think that Donald Patrony and Tom Chapman and Patrick for leading the charge on most of the discussion in this, and the other IFC members you know, fill in from time to time. But those folks, if you see them, you know, they're the ones that actually led the charge on the IFC.
Great. All right. Let's move ahead. Again, continue to ask questions as we go along. I'm actually going to have you move to page 34. This is that Monte Carlo testing that I mentioned, where we try to look at how bad could bad be, and then what does the long-term expectation look like. And so here you see at the top row what each one of those 10 portfolios could look like in a bad year. I mentioned that the portfolio that we're focusing on looks somewhat like you know, not the extreme right end of this, but between the middle and the right. But the current return, total return focus in green is showing that in any 1 year, you could expect you have a 1% chance of losing 20%. The total return focus proposed moves to 21. The 70-30 is almost 29%. So having that simple kind of policy or risk guiding portfolio, if implemented in just that way, is much more exposed to the downside markets that could occur. And in our current investment policy guidelines, until they're potentially replaced, at the bottom of this page, these portfolios, the return focused ones, were required to avoid losses greater than 22% with a 99% confidence level. So the 70-30 clearly would not meet that goal on an expectations basis. The total return focused is inside that at 21.4. And if you look at the reasons, again, for pursuing a little bit more chance of a loss on the downside, even though we already have about a 20.4 in the current structure in green, you can see the 10-year outlook at median is showing you that you're expected to earn a return more like 6.1% for that proposed portfolio versus something more like 5.4. And a 70-30 is more like 5%. So I just wanted to point that out. The expected loss at the 99% confidence level or 1% chance of occurring number, since that is in our policy right now. So maybe just going back to page 31 to see if you have any more questions about the proposal. I'd be happy to take any other questions before we move to the income-focused permanent funds.
I would say, Becky, just that this is the closest I've ever seen one of our proposed portfolios to the efficient frontier. You know, so that's one of those things that it just kind of really pops out that that we're so close to getting it as about as good as you could get it there.
Great, absolutely.
Okay.
Comfortable moving on to income as you consider this direction?
Sure.
Okay. Page 37, the income permanent funds, same kind of format. When you look at the information in blue, this is a bigger change in terms of lightening up in U.S. aggregate fixed income exposure. The current allocation is 35%. We're looking to change it to 12. So it's important that we look at, of course, expected income as a result of this. And I can assure you when we look at the rest of the information, we're getting yield to replace that. We're getting it elsewhere. So with the 23% reduction in U.S. aggregate fixed income and a little bit of trading of lightening up on core real estate and in exchange replacing it with non-core real estate, which again, you have investments in both, but we're just looking at moving a bit more to non-core and financing that, moving it from core. Where are we putting the rest of that 23%? We're putting it to a bit more in broad international equity. There are higher dividend yields on average in international equities, which helps us on our income focus. We're putting it in preferred stock. You already have an allocation there from a few years ago. This is putting more because of a better yield expectation there relative to investment grade fixed income. Putting it in private credit. Again, this is an area where in the private markets, we're able to pursue more yield, and per Treasurer Meyer's comments, tend to be floating rate. So you're not necessarily exposed to a rising interest rate environment. It's basically a credit risk, some asset backed, some other types of credits, but establishing an allocation there to replace some of that, what we think will be very low yield in the US aggregate. And also adding infrastructure per Mr. Chairman, Governor's comments on what is infrastructure. There is a cash stream that is very helpful at yield stream that is helpful in many types of infrastructure investments. Some of it, again, can be adjusted in inflationary environments. So that's another source of yield as well as diversification. And then finally, establishing a hedge fund allocation here in these portfolios as a ways to find some areas of return possibilities that's not tied to one specific asset class. So those are the changes. When we look at the movement in fixed income and cash, so that's moving down fixed income and cash by about 16%. When we look at the increase in public equity and alternatives, that's where it's going. It's below the 70% cap on book value. When we look at what's happening in the thematic exposures, we're lightening up on capital preservation, and we're adding most significantly to growth, but also to inflation and alpha tools. And the return impact as well as risk, when you look at the next set of information, the expected compound return, we expect to improve by 88 basis points, 0.9% roughly. And the estimated yield improved by about 71 basis points with all these changes on a net basis. And then finally, when we look at, again, in the change column at the very bottom, the worst case markets, we think that we could possibly lose 1% more than in our previous or current structure. But we think at the median over 10 years, we think the return could improve by about 1%.
So Becky, couple questions.
Yes.
I mean, this is obviously tilting more towards total return. And I'd understand why. I do wonder what this does short term on income, because if we're moving more to hedge, and I think you and I've talked about this before, I hate thinking of hedge funds as an asset class, because I mean there's such a variety there that I've always felt, okay, what hedge fund are we doing and what's the reason? Why do we need to fill that piece? The real estate and infrastructure, I'm just curious about what that's an investment. Is there a tie-up on that? And is there, when does the return start to come in? Not return, but when does the income start to come in? I'm just curious, because there's a pretty broad swing to, and I'd argue that the 70-30 is really immaterial on this, because that's not the way you'd invest for income anyway.
Right.
So I guess I'm curious, overall, what the expectations are on short-term income and income following a correction. And then, well, anyway, those would be the two things. So,
sure. Well, to your point on the shorter term, while you're investing into some of these private strategies like non-core real estate, like private core infrastructure, those are going to take some time to establish, both to just have their drawdown vehicles in many cases. And so you're investing like private equity with capital calls. And that's the case in private credit too. So we will have a discussion. We were planning at the end of this particular conversation to say, what do we do until those investments are called? And you have some choices there. Some are keeping it in investments that are generating yield while you're waiting to invest in those strategies. So finding a liquid alternative, or just looking at short-term fixed income, which again doesn't provide a lot of yield, but it provides some. So in the case, and it's completely dependent on the actual vehicles used, but in the cases of some infrastructure, that yield is being paid out through the life of the investment. In the case of non-core real estate, that can happen as well. Hedge funds, I agree with you. It depends on, if you're building a diversified strategy, it's definitely not typically oriented at pulling yield, but there is a yield component to private credit, which is paid out, even though it's a private vehicle, that yield will be paid out. Of course, preferred stock is going to have yield paid out. So you're right, on the hedge fund piece, it's really more at diversifying the growth engine of the income-focused portfolios, which is part of it. But some of these other strategies are really there for providing some yield enhancement over what you could get in traditional investments. But to your point, they take a while to establish, and you will be, in some cases, in a yield-oriented investment, at least partially, while you wait for those capital calls.
Okay.
Maybe while we're on yield, with your indulgence, I'd like to move you to page 38, the next page. One of the things you'll note is on the bottom, we've added another curve, which is yield. And you can see where the current yield is. And you can see what the yield reality is of each one of those efficient portfolios, including the proposed IFC in blue. And you'll notice that we're kind of capturing the most yield we can before you really start going for more return on that particular chart. And it is an improvement in expectations relative to the current yield, taking all the asset classes into account. And notice where the 70-30 is. It's providing an even lower expected yield than the current portfolio. The other things I'd point out on this chart, when we go back to expected return and risk and move away from the yield conversation, when you look at where the portfolio, the current income portfolio is plotted close to portfolio 3, and then where we ended up with a portfolio that plotted, close to 7. And then you'll notice, look how flat the rest of the curve is. As you look at the portfolios to the right of the proposed, you're just not getting a ton of incremental return for taking on that risk. And in fact, the yield goes down. So we were trying to find, an optimized point between these two realities, income and the risk return space. If you look now at risk in a little bit more detail on page 40 for these income funds, what you see here in that first 1-year result, the first percentile, which ties with our investment policy language to avoid annual losses greater than 22. This is going to be less exposed to a loss of that magnitude than the return-focused funds. And in fact, you can see the number for the proposed portfolio is 16.4% loss expected at the 1% level and 15 in our current structure. So you're accepting more volatility here on the downside. A 70-30 portfolio, we reviewed that in the previous chart for the capital appreciation or growth-oriented portfolios, that's 29 roughly. And if you look at the 50th percentile for 10 years, what can you expect in terms of return for 10 years? We think the expected return goes up by about 1% from 4.8 to about 5.8. And again, for just equities and bonds, it's a more modest, approximately 5%. Again, we can go back to page 37 for any specific questions about the recommendation.
Yeah, and on that, Becky and Mr. Treasurer, yeah, I mean, I understand the intent here, and I applaud it. I just, as an investor, certainly makes sense. As someone who needs to make sure that out years we have the same income being delivered or close to the same income, and exposing ourselves more to volatility, particularly equity. I mean, hedge funds could lose money too, but my concern is your yield would significantly change if you had one of those events, just because you'd have less to invest. So that was really my concern. And I think I just, Mr. Treasurer, I'm a little bit concerned about, whether the IFC was wanting to take more risk than the state as fiduciaries we would want to.
Well, Mr. Chairman, I can say that we did try to restrain the IFC in the direction that they wanted to go as investors, but I think that they came up with the compromises themselves. And when we look at the implementation of it, this will take some time to implement, and Patrick is more adept to the nuances of the implementation, which I think is going to be important as this rolls forward. There are some things that in different areas where you can get into secondaries and you lose the J curve effect and get your income coming in quicker. However, you know, you get double fees in the secondary market, and sometimes those markets have they're even a little hotter than the original market. So, you know, we go into it with, I think, open eyes, understanding the risk associated with markets that are you know, they're at the top. We all saw the I guess the graphs of earlier, but knowing that we're charged with investing in a risk return basis, and I think that we're you know, we're accepting that charge, and we're accepting our fiduciary roles. So I guess we can, you know, continue with the presentation, and we'll get into the implementation. There's some discussions along that need to be had.
Perfect. Thanks.
Okay, thank you, Mr. Chairman. Let's move to Pool A on page 43. I'm going to sound like a broken record as I go through many of these recommendations, but again, the fixed income markets here, focusing in blue, lightening up that allocation significantly by 19%. And when you look at the equity categories, we are making some shifts there, lightening broad US equity, adding a bit to small cap. So again, pursuing a little bit more return with the small cap and exchanging some US equity for international. As you look further down the list, again, part of that US aggregate exposure reduction is going to private credit to get a better yield at 5%, to core real estate, adding to your current exposure there, adding also to your non-core real estate exposure, and then finally that other theme of adding hedge funds here. So Pool A, when we look at what we're doing at the macro level, we're really taking 14% out of fixed income and cash and adding that to public equity and alternatives. We're reducing capital preservation by 19%. It's still 35, but it's more of an equal exposure to growth at 34. So that's increasing a bit. And as you look at alpha and inflation, participating, you weren't previously participating in hedge funds in this portfolio, looking to establish a 5% allocation there in that alpha category, and adding to the inflation tools that also help service in income and diversification. So thematically, that's what we're doing. In terms of impact on compound return, we do think in the third set of boxes from the bottom, 74 basis point improvement, and an estimated yield improvement as well of about 0.5%. You can see what happens with risk at the bottom of this page, with basically a worst case market result being about 60 basis points less, still losing somewhere between 10 and 11% as before, but closer to 11 in this case, in a 1 year period, 1% chance. And then over a 10-year period, the median expected result is improving by about 81 basis points. The picture is on page 44. You can see we're shifting from, in essence, is something that looks from the left-hand side of the curve to the middle, near portfolio 5. And as you look at page 46, this is looking at that same, worst case market Monte Carlo simulation. The numbers that I stated for the first percentile 1 year result, just a little bit lower by about 60 basis points, looking at Pool A proposed compared to the current Pool A. And there's that 50th percentile in the bottom right-hand corner, the 81 basis point return improvement. And the current policy language here is avoiding losses of 20%. So in any 1 year at the 99% confidence level. So again, even if that language were to stay, there wouldn't be an impact. So again, going back to page 43 for any questions that you have.
Looks good.
I'm wearing everyone out.
No.
Okay. Let's go to workers' comp. This is a different animal on page 48, as you all know. This is really pointed at liabilities plus a surplus, and you're in very good shape from a financial health perspective in the workers' comp plan. You're going to see some changes here where we're actually looking in blue to reduce the allocation to that liability hedging fixed income. You have a large percentage of the portfolio at 62. We think you can lighten up a little bit because of the financial health of the workers' comp plan to 56. Again, for all the same reasons that we stated before about interest rates, but also again, because this plan is very healthy in terms of its funded status and its hedge ratio. When we look at the other themes that we're looking to implement, it's moving some from equity overall. You'll see reductions there, removing small cap, moving large cap US equity down by 2%, and moving international down, adding just marginally to MLPs. They have a very nice yield, as you know. Adding to emerging market debt, again, a better yield and some diversification for our portfolio. Private credit, establishing an allocation there. We've got the ability with the liquidity profile of the workers' comp plan to consider adding private credit to this portfolio, as well as adding incrementally to core real estate, just 50 basis points. And then adding core infrastructure here again, illiquidity here on a relative sense, but also a yield-oriented investment helps with diversification and establishing a 5% allocation there. Some of the overall themes where it's just a 2% shift really between public equity and alternatives and fixed income, so a little less dramatic than the other funds. When you look at the thematic composition, we're lightening up on capital preservation and increasing the inflation bucket a little bit to growth. When we look at the impact on compound return, it's increasing by about 21 basis points, so it's a marginal improvement. Yield isn't as big of an issue. Payout of yield isn't necessarily as big a structural issue or need in the workers' comp plan, but it does improve. The one thing that we do is we actually, instead of just optimizing, trying to create the highest return portfolio for the least amount of risk, we're looking at how much your surplus moves around, surplus volatility. And that's our definition of risk. So we're taking a little bit more risk in this portfolio that we're proposing, but it's marginal at 15 basis points. The degree to which your liabilities are hedged, it's called an interest rate hedge ratio, is actually over 100%. So we're moving that basically back to 100%. And your funded status in a 2 standard deviation event, so a very poor market environment, is roughly going to be the same with the proposed portfolio, just down 148%. The good news is it's over 100 by a large measure. And then finally, you can see the return here. The worst case market, instead of losing 14.5, with the diversification will actually be a little better in case, which is different than the other portfolios, by about 2.9%. And the expected return, again, marginally better at 25 basis points. And if you look at what other workers' comp plans are doing, They're doing some of the same things that we have other clients that are workers' comp plans, and they're exchanging public fixed income for private fixed income. They're looking at these other diversifying strategies, trying to find yield in a yield-starved environment. So these themes are something you would see as you look at other plans. Just a picture on page 49 of the workers' comp plan. Your funded status is 168%. The duration of your liabilities and your fixed income portfolio that's custom is looking to match that, is about 11.4 years. You can see the provision for adverse deviation in light blue above the obligations, which are shown in dark blue, hence the good financial position that you're in. So again, it's really a liability-driven investment strategy than just looking at risk. And the picture of it is on page 50. So the chart looks the same, but just know it's the surplus moving around in size, the surplus volatility that we're optimizing here instead of just return variability. And note that we were basically, when we looked at this and created this model, we in essence moved from the square to portfolio 7 that the Efficient Frontier produced. And there's some definitions following.
Becky, I just want to make a little remark here, because with this surplus, some people might look at it and say, well, it's time to lower our workers' comp rates. And what you have to really remember is that you have old employers in here that have built this up. And it would be probably new employers that would say, coming into the state saying, well, you've got a great workers' comp program, so you should be able to lower these rates. And the problem is that you have that transfer of liability, and sometimes when you do this, and just remember that every time that we lowered the rates into our retirement systems, in the end it came back to bite us. So I think that we need to have a Mr. Chairman, Governor, I think we need to have some kind of a uniform message on this workers' comp to let people know, if it comes up, why it's not a good idea to essentially try to raid this, because we could end up just like Fire A. So that's I guess that's my 2 cents on this. That be cautious, be frugal. We got a great program. Don't mess with success, basically.
Mr. Treasurer, I couldn't agree more. It wasn't long ago that we didn't have this sort of situation.
Absolutely, yeah. Thank you, Mr. Chairman. Sorry to interrupt, Becky, but while it was in front of us, I wanted to get that message across.
No, I'm so glad you did. I didn't have any other comments on this unless there are questions on the proposed changes that are outlined on page 48.
Looks good.
Can you believe you made it through all the proposed changes in all the funds? Because LISRA is next. We aren't proposing anything on LISRA. Page 54 is just a reminder of, that $1.5 billion, what its fund horizon is and investment goals are. And then actually the picture on page 55 and reminder that, that long-term reserve component of LISRA is really looking more like our long-term portfolios in terms of asset allocation, but then you also have the intermediate and short-term reserve. So we just put this in here for reference with no recommendations on LISRA. And Mr. Treasurer, I don't know if you had any other comments on that at this time.
No, I think, Becky, Mr. Chairman, we'll find out, I guess at the end of this budget session, exactly what's left in LISRA. And we may have some recommendations at the end of that as far as whether we end up with continue with 3 funds or whether it goes into more of 2 funds. Kind of depends on what the size of LISRA is and the expectations and the directions we get from the legislative process. So.
Great. Thank you, Mr. Treasurer. So on page 57, if you need your readers out to look at this page, I wouldn't be surprised. I basically would need to do that if I couldn't just expand my screen. But we wanted to put on one page all the recommendations for the funds where the IFC is proposing change. Thanks, Jake. You just expanded it for everybody. That's great. So this, you can look across this in many different ways. One thing I'd call your attention to, which was the theme of today, is the U.S. aggregate fixed income for all the funds lined up there. You can see the decreasing allocation recommendation. You can also see that for some funds, there really wasn't any change in equities with a few exceptions. You're seeing the continuation of some of the investment strategies that you have in the past, like MLPs, and really not a whole lot of change there. Preferred stock, so you make your way through this, you can see the themes of the changes, but basically to summarize them is with lessen dependence on fixed income. We've looked elsewhere for yield and return, adding to private equity in the case of the permanent funds, adding private credit, kind of across all of those funds. Real estate continues to be an important allocation across the long-term funds and income funds and workers' comp. Introducing infrastructure is another diversifying asset class that has a yield component, and that, again, we'd be happy to provide some more education on. There's many different flavors of infrastructure, but introducing that into the total return income as well as workers' comp. Hedge funds, again, we've had some good discussions. It all depends on how you implement hedge funds, but in a return environment that tends to look a little bit less favorable to some traditional assets, it's nice to have some flexibility in being able to choose funds that aren't just committed to one market, but can be somewhat flexible. So you're seeing increases here for total return income and Pool A. When you look at the change in the public equity and alternatives kind of across the board versus fixed income and cash, you're seeing more being added to the combination of private equity and alternatives for all of the funds. Again, more significantly in the case of income and Pool A. When you're looking at the thematic composition, you're seeing in some cases, in most cases, a significant lightening up of capital preservation assets in exchange for both growth assets as well as increasing alpha and inflation. Generally, when you're looking across all of these recommendations, you're seeing an improvement in the compound return. You also are seeing an improvement in expected yield. And when you look at the bottom of the page, in all these cases, with the exception of workers' comp, it is saying that we can, in pursuing a bit more risk in the portfolio on the downside and variability, we think that that will benefit these plans with the longer focus and result in improved return. So if you actually, on page 58, look now at the sovereign wealth peers, you can see in green where these proposed portfolios would move kind of to the left in terms of taking more risk assets. Certainly not at the level, quite at the level of 80%. Again, this doesn't take into account the book value feature of our current limitation, but just looking at the total risk assets as built out on a proposed basis, knowing it will take a few years to get there. but you can see that you're more in the company that you've looked at in terms of other sovereign wealth funds in the case of Permanent Mineral Trust Fund with that growth emphasis. For the income emphasis, Common School is moving from the third bar from the right up to more of a left-leaning position compared to where it was. So an improvement, not quite to the middle, but certainly moving there, but with its income focus, we think that's appropriate. And as I promised early in my remarks on page 59, we did plot both the current Common School and Permanent Fund portfolios on this particular chart and where they would go on a proposed basis. So the Permanent Mineral Trust Fund, if you can make your way through all those squares, is the green square by portfolio 7. It's moving up on the efficient frontier to about portfolio 8, looking similar. Again, peers don't drive what you do in Wyoming, but just from a comparable point of view, on an expected return and risk perspective, more on the upper part of the efficient frontier, looking more like some other peers like Texas and Alaska. When you look at Common School, it's moving from the blue to the orangey brown near portfolio 7. So again, as we look at the diversification suggestions and improvements in these portfolios, we like the direction we're heading on a proposed basis. So that's kind of the summary of the recommendations. We have yet to talk about the implementation and transition considerations, and I'm sure Patrick and the treasurer will join me for this conversation. But I wanted to pause there before we talk about implementation, because the implementation is only relevant if we actually head in the directions that we proposed.
Becky, the only question that I would have, you know, at this, and I'm thinking really, well, it'd be real estate funds, it would be hedge funds, and it would be private equity funds. Is there a survivability bias to those, and should we discount any of the expected returns because of that?
Survivability meaning
the hedge funds that fail, or the private equity funds that fail, or the real estate funds that fail don't get counted in the.
Oh, yes, yes. So when you're, that's a great point, Mr. Chairman, Governor. A lot of folks, when they look at investing in these asset classes, you're right, they look at assumed returns and say, I want that. Now let's go do that. And we know that it takes a lot of expertise, and let's take private equity because it's the most extreme example. But private equity, if you don't execute at a better than median level, then, you know, if you just get average returns in private equity, it may not pay you for that illiquidity. And to your point, you know, there are some funds that fail. So yes, private equity is important to continue to do an excellent job in pursuing and working with your advisors to find those investments and holding them accountable for the decisions they make, knowing, and I know this is behind your question, that you're stuck with it once you commit to a private equity fund. So yes, in real estate, you know, certainly the difference between the top performing, especially non-core real estate, and bottom performing that actually run into problems. That is a wide difference as well. There's a little less of a wide difference in the core real estate area, because in core real estate, absent, you know, obviously issues that happened this last year to retail properties and core central business district properties, but hospitality as well. There's been pressure in that core area and a difference between the top and bottom. Historically, though, there's much less, because 80% of the return in a core real estate portfolio is due to lease income. And in fact, due to that lease income stream, you can absorb capital market losses in some cases to some degree. For a while, it lessens overall return, but there's less of a difference between the top and bottom performing because there's more similarity in the income composition of those funds and the degree that it's most of the return. Core real estate, it's more like, or non-core, it's more like 60% of the return is income. So it helps when you do get a markdown of properties. And the key to both is the ability to have a long-term time horizon to be able to write out those asset prices and not sell in a distress point. Hedge funds is probably where the survivability or survivor bias tends to come in as a discussion point more often. And obviously there's always some news in the hedge fund world about strategies that have been impacted. If you look at the whole GameStop scenario and hedge funds being, a few hedge funds being exposed to that because they had big short positions, and the retail investor anomaly that happened, if you will, is certainly something that we've studied. But generally, hedge funds have been the one that folks have talked about, saying, if you're looking at a universe of hedge fund results, how can you take away any concrete conclusions about the future? Because number one, they're highly diversified and really could be highly variable depending on their strategy, use of leverage, et cetera. And also there's a big difference in terms of those that have been highly successful, those that are flexible in their mandates. So survivability or survivor bias is really a big issue, I would say, in the hedge fund market, and something that I know, your staff, as they're looking at hedge funds and external advisors, that's one of the things they're charged with doing is, number one, looking at the needs of each one of these plans and saying, what kind of hedge fund program is appropriate here? Clearly not full high equity beta strategies just shooting for return. We're looking for diversification here. And one of the things we like to do is make sure that when you're talking about hedge fund implementation, that we constantly look back at these asset class assumptions and say, are we modeling the kind of hedge fund you're going to get exposure to correctly? Or is there any adjustments that need to be made? Because survivability definitely, or survivor bias is definitely an issue in the databases. So you bring up a great point. Sorry for the long-winded answer, but I wanted to make sure to hit all three asset classes you mentioned.
No worries. Thank you. Thank you, Mr. Treasurer.
Any other questions? Okay.
Should we talk about transition, Mr. Treasurer, on page 60, and then maybe the other charts that were prepared?
Yeah, how's everybody doing on the break time? Does anybody need a break right now? Just asking. Looks like nobody but me.
What's for lunch, Mr. Treasurer?
Huh?
Yeah.
Lunch? 10:40?
What's for lunch?
Is there a pizza coming?
I don't know. We'll have to get DoorDash to every one of you guys. Huh? How's that sound? Well, let's go on and we'll look at implementation there. I am going to step away for just a while, and Mr. Chairman, Mr. Governor, you have the.
Thank you.
So, Mr. Treasurer, Governor, would you like me to make a few comments on if the suggestions were consideration for, or were approved for implementation, what implementation options are and transition considerations?
Sure, that would be great.
Great. So in this packet, we have just one page on this. We do have another set of slides that actually look at what could happen in terms of various decisions you may make on implementation and transition. But we've had a lot of questions today as we've gone on, or at least some that have talked about, this is some significant transitions that we're actually laying out here in the recommendations, moving away from fixed income allocations at the levels that they were, and moving into some asset classes that will take some time to implement because they're illiquid or less liquid. So one of the things we know we need to do is in any of the funds where we're looking at increasing private equity is we need to update our pacing studies. And just a reminder, those are looking at how much you need to look at committing every year in funds, additional private equity funds, to achieve your investment policy target over a foreseeable horizon, taking into account not only the expected growth of the fund, permanent mineral trust fund, for example, net of distributions, as well as looking at how the private equity investments call capital as well as distribute capital. So that would need to be updated with the amended long-term targets. In private credit, there's some decisions that would need to be made in terms of whether you would pursue these private closed-end funds like private equity, or look at structures that are open on an ongoing basis. We call that evergreen, or some kind of hybrid between the two. So that's more education and more research that we'll all collaborate on. And then kind of similarly in infrastructure, pardon me, there's an evaluation of, again, open funds, we call core open, you could call them evergreen, versus direct infrastructure investments or hybrids of the two. So clearly there's more education that needs to happen here. There's also considerations that a next set of slides will address, and Jake, you can bring those up in a moment, about while we're waiting to actually identify more private equity funds, more private credit funds, and make the structural decisions, where should investments sit relative to those new asset classes when you're waiting to make structure decisions and waiting for call down of capital? And so some investors choose a couple different methodologies. One is outlined on this particular page, is using liquid proxies, we call them. An example on the right-hand side is taking this allocation to these less liquid asset classes and putting them in something that looks as much like them as possible, but is liquid. So private equity, that would be for capital you're expecting to be called, you would have that investment in public equity until your private equity managers call the capital. That's a very traditional one that's done. For non-core real estate, you could, because you can't put non-core real estate that will be called in core real estate, because core real estate is also relatively illiquid. But you do have REITs you could invest in that are equity securities of real estate firms or firms involved in real estate businesses. So that's an option many investors have chosen. Again, it's choosing something that looks as much like what your target investment is, but it's liquid. Infrastructure, you could actually choose, if you're going to go into private infrastructure, again, examples that were brought up would be, toll roads, ports, airports, infrastructure, highway infrastructure. There's a lot of different examples. There are listed infrastructure stocks that trade on the markets, and that's something that could be chosen. In private credit, you could split that money. You could leave some of it in fixed income. In a lot, that's a lot where a lot of money is coming anyway, is just defer it and keep that money in a combination of bank loans and fixed income. Bank loans are the thing that's most like private credit, but they're more liquid. So you could come up with a strategy like that. So that's the liquid proxy idea. The other idea is that while you're waiting for private equity, non-core real estate, infrastructure, and private credit to be analyzed, structure decisions made, and managers identified, and then for them to actually call down capital, you could decide to put investments in low duration until the assets are ready to be called. So it's a low duration fixed income. So we wanted to at least give you a sense, and Patrick, please jump in with your comments, because timing and additional considerations are really important here too. But if you look at The left side under green, the total return focused, the current portfolio's expected compound return is 5.23, as we covered in our previous analysis. The proposed portfolio is 5.79. If you use these proxies that I just described in the upper right-hand side of this page, you would earn a return that's going to be north of our current portfolio, but certainly south or less than the proposed portfolio if you invest in those liquid proxies. You can see the risk is 11%, which would be less than the proposed expected risk, but certainly is an increasing risk as you move towards those investments using liquid proxies. And then on the right-hand side, if you were just to basically put the monies that are destined for private investments in low duration fixed income, the idea here is to not expose that capital that's due to be called for these private investments, not expose them to significant variation in value or capital market movement, then your expected return, as you can see in compound terms, is about 5.21, about the same as your current portfolio. So which way is right? This is a matter of study, conversation. We wanted to quantify this to give you an illustration of what it could look like. The advantage of the proxies is you get some market movements that look like the eventual investments you'll be in. The downside is that those proxies are liquid and subject to market movement and volatility. The upside of using low duration while you're waiting to make the structure and receive the capital calls, that's the advantage, is you're able to really protect those assets that are destined for those other asset classes. The downside is the return is not as good, but the risk, as you'll see, is 9.7 versus 11. So there's no one right way to do this, but we wanted to highlight those two ends of the spectrum. Patrick, I don't know if you want to jump in here with comments, but certainly feel free to.
Sure. Thank you, Becky. Mr. Chairman, members. Yes, I think Becky, is exactly right on this. Just a couple things to point it out. I would argue that it's really the amount of risk that you want to take and when you want to take them, because clearly the liquid proxies, if you just look at each one of them, private equity, public equity, highly correlated to the equity market. Non-core real estate, the global REITs, actually they are even more correlated to equities than they are to the real estate market. We've done many studies where you see the global REITs will sell off in any down market much more than the like Odyssey type core funds that we look at. But then on the bounce back up, they do very well. So that is something that we look at for timing mechanisms when we're going in and out. The infrastructure, again, these are more proxies for funds that are involved in infrastructure, highly correlated to the equity market. And private credit would be much less volatile, obviously, because of the split that you have. And the core fixed income, some funds, for instance, when they do this, they segregate or differentiate where on the duration spectrum of the core fixed income they're looking at to change their volatility. And then obviously the low duration fund would be a much lower volatile way to do it. But again, you're not going to get that upside if the market continues to rally. So it would really be the board's pleasure, I would argue, on which way you'd want to do this, depending on your view of where the market is and what kind of risk you want to take.
So Becky or Patrick, and I see the treasurer's back, so excellent, if I may, Treasurer. One question on infrastructure. Is there a view on what this proposed new legislation might do to infrastructure investments? If Congress decides they're going to put bunches of bucks into bridges and but bridges and roads and airports and ports, does that space then become much less attractive? And I think about it from two ways. One, just where the opportunity set lies, and two, you know, when you think about what it means for steel, for cement, for you know, copper, for whatever is going to go into that infrastructure, it would just seem to me your return expectations would be pretty remarkably affected.
It's a great point. If I could respond to that, Mr. Treasurer, Governor, Mr. Chairman, Governor. Basically, when you're looking at that, yes, you're absolutely right. What you're in essence saying is the government going to crowd out other investors by putting public money in these areas? And that is a consideration. But one of the things I would point out is there's actually, when we look at infrastructure, there's a fairly global component here. It's going to be part of the education. This isn't just a US play necessarily. And so one of the analyses that we'll do up front is, what does the global environment look like? What do the funds currently raised look like? What emphasis is there in certain types of infrastructure? But the points that you made about US infrastructure, absolutely, those are some things we definitely need to take into account. And the US, as we all know, in many cases, has a lot of needs for reinvestment in these types of structures. As you look at other countries, they're in different phases of both mature economies that need that reinvestment, as the US does, and those that are building infrastructure and are earlier in terms of their needs. So many infrastructure investments do have this kind of a public-private element and combination of a public element that's a significant consideration going forward that we need to keep in mind. So yeah, it's kind of a unique time to look at this. But I wanted to just clarify it isn't just a US reality here.
So,
Mr. Chairman?
Thanks. Yeah, please go ahead.
Yes, could I just add to that, to Becky's comments? You know, she's spot on when you're talking about how you're looking at the markets, because as you all know, US infrastructure is not that large in the global sense, and that's primarily because we have an extremely large and liquid municipal bond market. Mm-hmm. So the vast majority of the projects that we see in the United States are taken care of in this very liquid municipal bond market. So I know you've seen estimated numbers of, you know, $3 trillion over the next 10 years that potentially could come in. I would actually kind of take the opposite side of that, saying, yes, we're going to have all these different issues, but it would also create a tremendous opportunity in certain areas. And one of the things that I would like to comment just in the private equity infrastructure area, one thing that I would argue that if we go into this avenue, what we should look at, just very similar to private equity, when we first invested this, we're looking in one of the most conservative areas, large cap buyout. So the same thing with private credit and infrastructure. There's a whole litany of different things that could take on a tremendous amount of volatility and illiquidity and issues. Or you can also take an instance, let's just use the infrastructure, where you're buying an asset that has very solid offtake agreements. So as the governor or chairman was mentioning, that you have these, you know, steel costs and so forth. If you have an offtake agreement where you know how much they're going to get and you have a variable cost that's associated with this, a toll road, for instance, if the toll road was able to adjust the prices that they're able to pay or what have you, and you know you're going to get this certain kind of amount, pipelines and gas lines and things like that, where they have these offtake agreements that you know beforehand, you know, these are more of the conservative, well-known returns. You don't get that very high return that you've seen in some of these, but you also would get a significant increase over a fixed income portfolio, where I would argue, you know, that many of them are rated. You could get very similar rated type of projects for the same type of risk that you're taking the core portfolio. The only thing you're trading there is the liquidity premium. And most of these, you can get, very long dated infrastructure projects and some of them shorter, but those, you're giving up a liquidity premium for a higher yield.
Okay, and is there a pacing component to this?
Depending on what structure you use, assuming that you don't go just listed infrastructure, yes, for the closed-end funds there is, and that's something that we'd look at. So with the education on what the market looks like, what the opportunities look like, how much we need to look at committing, we'll also look at, what makes most sense to get started for Wyoming.
Mr. Treasurer, do you have a notion of pacing on this?
Well, every asset class is going to be a little bit different. I know in private credit, I think we're going to have to increase our pacing up to about 250 a year. It's going to take quite a few years to leg into it, unless we do something in the secondary market. And you really want to look at, the returns net after fees and the risk associated with all of these different scenarios. And I think that, with reasonable expectations that within about 3 years, I think you'll get most of it put in there. I don't think you're going to do it in a year's time, in 2 years' time. I think it's going to be in that 3 years' time as far as developing the pacing, and some of it still may not get put into place for a while. It's going to take a while. Infrastructure is a new classification for us, so that due diligence in sourcing best-in-class managers is going to take some while. Hedge funds, I think, are going to go in relatively quick because Matt Schmagosh is continually looking for new opportunities, and so we've onboarded a new employee just yesterday that has a great deal of experience from ADIA in private credit. So I think he's going to help us out a lot in the private credit part of it. He's going to bring a lot of knowledge of different managers that he has some trusted relationships with, that we can maybe get a jump start in some of the private credit. It's a fairly substantial change in the overall 12 to 15% in the asset allocation. So this isn't going to be a fast process. It's going to be, as we always do it, it's going to do with a lot of due diligence, a lot of research, getting the absolute best people to move forward. And in the meantime, we may use some of the liquid proxies, but we can always fall back to the low duration. I expect that we're going to have a great deal of low duration in the beginning in the process, primarily to take some of the risk off of the risk that's perceived in the fixed income, especially in the longer duration part of the fixed income that we have. So there'll be a lot of strategy, I guess, involved, and that's another good thing about the new employee, that he had I think it was 6-7 years in ADIA where he did tactical and strategic allocation in fixed income and worked with private credit. So I think I think Patrick found the perfect employee for at this point in time with the changes in our asset allocation.
Yeah, so I just stating at a high level from, and I don't mean to be the only one chatting here, so I apologize to anybody else, but in the total return, I don't see really, my concern was really about pacing and trying to leg in over time, because, everybody's been excited about private equity, and that's going to make it expensive. It's going to make it difficult to find. And there's probably, we all know vintage years change pretty dramatically. So if there's a pace to that's not crazy, I don't have any real concerns there. And my comments on the hedge funds, I know, I just hate it as an asset class, because I think there's each strategy is correct for a particular thing, but not just, we'll just do hedge funds. And I know you know that, Treasurer. The one I'm more concerned about, quite frankly, is income focus and just what that does to the income. And I think that's probably related to pacing too. But you're going to move to more liquid proxies, which may reduce a little bit. I mean, we know what's happening to fixed income anyway. I'm a little anxious about putting risk on too quickly there at such a volatile time.
We share those concerns, Governor. Patrick, myself, I think the whole staff, and to an extent the IFC also. And myself personally, I'm not too excited about global REITs on non-core real estate. That seems like that's a lot of risk, as well as listed infrastructure. I think that's a lot of risk. But we'll have these discussions, and my office is only 100 feet away. Come on down. We'll put the pot of coffee on, and we'll talk risk and pacing, and bring Patrick over and have a good discussion, because I think that we're all on the same page. It's a difficult time. We know we've got to do something with our fixed income, because it just isn't the horse that it used to be, and needs to necessarily go out the pasture for a while. May come back out of the barn and run good races in the future. But for right now, we've got to make a few tweaks here or there. And it's putting those things into the portfolio and the implementation, doing it right, so we don't stub our toes. And we're gonna do it with a lot of due diligence.
Yeah, and so my only thought was, if we could be a little more conservative and keep our IFC happy by saying we're working our way there, I'd feel better with that. But
well, that's where I've got to be the I think the meter on the process, and talking to Patrick, I think that's something that I can shoulder and keep it at a pace that is prudent, looking at the fiduciary responsibilities that we all have and share, and making sure that we implement this, but at a pace that doesn't get over the top of our skis.
thanks. I'll be quiet now.
Okay. All right. That's all right, Mr. Governor. Always a pleasure to converse about in investments. Now, Patrick, you have any more discussion as far as the pacing and some of your thoughts associated with it, and how we can alleviate some of the risk?
Yes, Mr. Chairman, or Mr. Treasurer and Mr. Chairman, the risk that we're looking at, as we said, I think Secretary Buchanan mentioned before about valuations, and fully agree that these valuations are rich, but we just don't know. I mean, they can continue to go up, And so that's one thing, we don't have a crystal ball. And so, to look at these and saying they're extremely, expensive on historical return, if we do the pacing schedule per se to where we can level out those times, we're never going to, I can't at least, sell the top or pick the bottom. I'm not that talented by any means. And so a lot of times when you look at this, if you could look out over time and be able to just take a, as the governor alluded to, that vintage year, then over time it seems to make sense. But as you know, I think by far the most conservative member on the IFC, and just full disclosure, there are many of the IFC members who feel that RVK's assumptions were too conservative, that they looked at other brokers and people out there who had higher return assumptions than what RVK did. So, those are factors that I think you want to take in. But the ability to take on more risk over time with a proper pacing schedule, in the sense that you're selling an extremely low yielding asset, i.e. core fixed income, where we're getting minus 70 basis points in real yield. So we're not even beating inflation, which normally it yields 2% positive. So we're minus 270 in this asset class in just US Treasuries. So, there's a problem with that aspect. And if we could, have the flexibility to go into some more risky assets over time, I think that would be wonderful. With that, the other thing that I would love to just hear is the rest of the board members, after looking at this, do you feel, is some of these allocations too risky, not risky enough, or I'd love to hear your opinion as well.
Ed, let's start with you. You're on the top of my screen, and I don't even have the superintendent on the screen. So you'll Ed and Christy, and then Jillian.
First I'll answer the question. I don't really have an issue with, other than wondering if, and I got a thumb back here, maybe it was on the total return focus, and Patrick mentioned it there, the overvaluation of equities in there. But I overall, I don't have an issue with what the proposal is. I guess the question I would have is, with the comment you just made about the IFC being more conservative, and they've looked at other groups that may have forecasts that, or maybe it's modeling that isn't as conservative as RVK. But I guess my question is that just the modeling, or is that a different strategy that others would take that they think would somehow produce better yields? Because to me, you can say, well, your RVK's outlook is too conservative. To me, there's a lot of safety in a conservative outlook. So I appreciate that approach. But I just wanted to make sure that the IFC wasn't saying that there was some type of model that would inform their proposals more thoroughly, such that we could actually get greater returns, if that makes sense.
Well, and I work with the WRS. They use a different set of consultants. They have a little bit different way of looking at risk, and it's called a discounted model, where it's the interest rate yield figures into it. The only problem with that is that it looks better now, but if interest rates go up, then it starts to get pretty dicey real quick. And with the assumption that the long end of the curve is going to get higher, then yeah, I'm not really sold on their model for developing a risk analysis as to being as good as what RVK uses. So, yeah, to answer your question, yeah, there's different modeling aspects out there, and there's different people that have different risks. But I think that RVK is in the ballpark, but maybe on the lower end of their return assumptions. But you know, I think Becky said it's better to be pleasantly surprised. I know I like it when I do a test and I think I got an 85 and I end up with a 95. I'm really excited, you know. So, you know, RVK, I think, is a consultant that we've relied on in the past, and I think we can continue to rely on them.
And just to clarify, you know, the point is I think there's a great appreciation for being pleasantly surprised and being conservative in your approach. Like I said, there's a measure of safety in that. I just wanted to make sure that the IFC felt like they were somehow confined from something they would rather do than what the recommendations that they made in each of these, I guess I don't know if they're focuses or foci or what they are, but for each of the funds we're looking at. So they didn't feel like their hands were tied, in other words, by anything.
Well, there are some constraints. There's a constraint on private equity. Otherwise, the model would have everything in private equity, you know, because the risk is lower and the returns are high. But all the problems that the governor alluded to as far as getting the money, you know, put to work in the pacing schedule, and you just don't snap your fingers and bounce into private equity, you know, it doesn't happen. But so they put those constraints in there, knowing that they were a reasonable constraint to make sure that you know, you didn't have over concentration by any single asset class, which that's the one thing that we learned back when we were looking at the land deal on Oxy, that we had an over concentration in one asset class. Had we put that in there, so they did some constraints in that regard, and I think the IFC understood that, and they agree that you don't need that over concentration in different asset in a single asset class. So constrained, yes, but understand that that's the way that it should be done. They agreed with that. Anything else on that, on answering that, Patrick?
No, I think you pointed it out, Mr. Treasurer, Mr. Chairman. The issues that we have, this is not, you know, we don't have one fund like most of these pension and endowments. They're spread across, you know, 10 different funds that each fund has a unique need and interest. And so we're much more complicated than the other funds that we're compared against. And just one other thing is everyone has their own opinion on things, but just I'm not saying you know, RVK's numbers are off base. It's just really a matter of opinion. And if you look at I think some of the new Kubo studies, Becky, you could comment on that, that they were, you know, very much in line on what they are. I'm a quantitative person, and so I look at where the rates are right now, and the modeling that the quants have done, and they actually would argue that RVK's numbers are high. So, you know, you have this whole wide array of opinions of where they should be. So you can't really pinpoint it and say, oh no, that, you know, a 486, you know, 10+ year return on equities is off the wall. By no means it's not. It really depends upon your opinion. And I think the treasurer made a great point, because the valuation depends upon your interest rate. So if you're of the view that interest rates will stay low, it's going to dramatically change your view of equity returns. And so that's the real key on most of these models.
Yeah, nothing further to add for me, Mr. Treasurer, Mr. Chairman. I would say that one thing that we find in working with clients that have deep investment teams. In fact, I'm working with one right now where they come up with their own assumptions, and then we have working conversations about how they do that, and then we ultimately model both for that particular client investment committee. And remarkably, we usually end up coming within 30 to 40 basis points at the total fund level in terms of return. But one thing that I can assure you is you will get different opinions about, asset classes specifically. I have a more favorable opinion of equities, or another person has a more favorable opinion of private equity or infrastructure. One of the things that we require this whole process to live within is recognizing that we're not coming up with just a single assumption in isolation. We're recognizing that we're doing it in a way where we're trying to come up with a set of assumptions and their relationship to each other and to inflation. So we're trying to come up with that whole capital market line that we mentioned earlier in our presentation. And if we find that a fundamental, assumption about that changes, we also have that asset class specific rigor as well to make sure that we get as right as we possibly can. And there's some more information in your primary presentation that we finished earlier on that process. But, we generally find, although there's going to be differences, asset classes to asset, individual asset classes with each other compared to other vendors, I think you'll find that that kind of moderate viewpoint, not counting on a single thing, bailing out the whole investment program, and making sure that we aren't overly dependent on one asset class. I think you'll find that the structures that have been proposed by the IFC is not betting the farm on any one specific strategy. But if anything, in this environment, saying, there seems to be, regardless of what you think the number is for assumed return in fixed income, there seems to be a general agreement across most practitioners that that is someplace that is just not going to be as rewarding going forward. And really, we're not counting on any one specific thing to be the hero asset class. We are spreading those ideas around. So there's a degree of conservatism in that as well.
Okay, Ed, anything else?
No, sir. Thank you very much.
Yeah, you bet. Christy.
Thanks. So just a couple summarized incoherent thoughts. Going backwards, the change to the workers' compensation don't concern me. I think they look good. I mean, obviously that's because we're drowning in excess there. Not that we should be any less concerned about losing it, but there is less concern there. And moving backwards to the other three, total return income and pool A, I like the increased investments in several of those in both real estate. I feel good about that. And I'm very interested in seeing how infrastructure does. And I think the increases there are modest enough. Again, like Becky just said, if it goes wrong, it's not a complete train wreck. I think the one thing that sort of jumps out on me at me is, even though everyone is pointing to the same thing, that the fixed income just isn't going to be fruitful, it's always a little disconcerting when we're doing the same thing in all of those. We're really pulling out in all of those, and that makes sense. I mean, that makes sense, but that's the one, we're making the same big change in all of those three things. And again, I don't have any real reason as to why you wouldn't. It just, you know, looks funny when you're risk averse, I guess. That wasn't really a question, sorry.
Yeah, no, that's okay. It's you know, like in appropriations, you've been there enough. Wouldn't you agree, Mr. Chairman? You know? So there you go. Now you got a question, you know, and so you know, it is a big move, Auditor, and that's why I think I need to reiterate that we are going to implement this with caution. We've taken a good deal of time with the IFC. Pretty much gave them free rein to develop these things. They are the experts, and I'm trying to remember. I think that most of these there was a unanimous ballot cast for them. There might have been one that maybe somebody dissented on, but I can't recall at this time. But I've asked Matt Sackett to check that out for me for sure. And it is a move away from you know, eventually knowing that your corpus is 100% secured to you know, some asset classes where you may not have 100% security, but you have yields that support what the business of the state is. And that is in part one of the things that we need to do. I feel that we kind of have a dual duty, because in the Constitution, it does talk about distributing income, and it also says protect the corpus. And we do that, you know, I guess with the mathematics that are involved in investing to make sure that our risk is at an acceptable risk. And we allow the legislature to put a cap on that. And we've stayed substantially under that cap, due primarily to our aversion to taking too much risk. Patrick, anything for comments for the auditor?
Mr. Treasurer, Mr. Chairman, yes, Auditor Racines, one area that we did look on your comment about the income is that we did discuss is looking at it is during this period when you're looking at, like I alluded to, the 9% return on a 7-year US Treasury. And so you don't really get that protection because the other aspects of a core fixed income, which would be mortgages and corporate bonds, have a tendency to sell off. One area that we did look at is saying, well, if we're going to be a little bit less conservative and taking on more risk, one opportunity that we might look into would be then increasing the US Treasury allocation. And so that would be something that you could possibly look at where many other funds, you know, Becky could comment on it, have looked at increasing the Treasury allocation within the core fixed income. Because right now we're about 40% US Treasuries of the core fixed income, and the rest of it would be other credit related components that are extremely expensive right now. So that would be one thing that we could look at as well.
Okay. All right. Yes, Jillian. I don't see you, but maybe you'll show up.
I am here.
There you are.
Yeah.
Thank you, Superintendent.
Thank you, Mr. Treasurer, Mr. Chairman. You know, at the risk of sounding like my dad or maybe even my grandpa, I've been around the horn for 6 years now, and I'm really proud of that. But still feel like a rookie a lot of days. But as I was just listening to Becky and Patrick and you and the great questions that were asked, I just was reflecting on a couple of things that I view as pretty profound changes, or maybe just things that we've had an opportunity to look at that we haven't in the past. And so number one, I just want to say that I appreciate this slow, deliberative, intentional process that all of you sort of lead us down and give us many opportunities to weigh in. I also really, really appreciate our access to members of the IFC and access to our VK and access to your office, Mr. Treasurer, because it helps profoundly. You know, we all on this board have really different entry points into this conversation. And I probably have the most challenging entry point in terms of, you know, not having a strong background in this area. And so I really, really appreciate the time that you all take with each of us individually and collectively. That said, you know, as far as just a focus on income and protecting the corpus, I agree with the changes that we're making, especially with respect to Pool A, and also really appreciate the auditor's comments about that. And then just 3 areas that just personally I've seen in the last 6 years that have just kind of fascinated me, that I've followed are, you know, kind of our increased focus on real estate, on emerging markets, and then, you know, and this hasn't been a huge focus, it wasn't today, but we were really looking at our investments in logistics, which of course have become just really profound now. So I look forward to just learning more, leaning in more on those investments and being part of the conversation. And I'll end with, wouldn't you agree, Mr. Treasurer?
Yes, Superintendent, I would agree that with you that and I would add that any I guess improvements that we can do with reaching out to the members of the Slib, any other educational opportunities that you would like to participate in, you know, we are always receptive to those communications.
Thank you, Mr. Treasurer.
Yeah. Well, I guess we're getting toward that end of the day here, where I guess we'll call for any other comments, and then it is I guess within the scope of the Slib board to approve asset allocations, and when we get to that, we can do it by each one. We can do it as a slate, and I would leave that up to the membership to make that determination. And so I guess I would call for any further discussion on any of the different proposed asset allocations, and specifically if you have, you know, any recommendations that you'd like to opine on as far as the implementation that Patrick and Becky, and to me of a lesser extent, put forth.
Mr. Treasurer, just a couple.
Yes, Governor.
I think this was noticed as a working session. Is that correct?
Oh, you know, it was. Yeah, so we can't. Darn. I'm ahead of myself, Governor.
No.
I guess we'll have to make this have to make those motions in the next Slib meeting whenever you schedule it there. So we'll do that. I apologize.
No worries. I think actually really excellent work. The only other question I'd have, and I note this with real estate because it's a wonderful asset class, but it tends to get bounded into at times, and then you know, timing is a little bit of an issue there. And I guess Becky or Patrick or you, Mr. Treasurer, do we have, and I don't really want to refer to them as stops, but places where we say maybe this isn't the right time, and I guess I think about that just a little bit from, you know, we all know how people look to one thing, and I think we already talked about private equity. We'll take that, over time, but sometimes real estate investments come in a big pile. And I'm going back to what the superintendent said. You know, there are two downfalls to real estate. One is if you end up with somebody like UBS that you can never get out of, and the other is if we move so slowly that we can't give you the opportunity to move as quickly as you need to.
Patrick, why don't you can take that. I've got some own opinions I'll probably follow up with.
Thank you, Mr. Treasurer. Mr. Chairman, one of the issues that we have is the inflation outlook. And so if you remember, as a board, we redeemed the TIPS allocation. We got out of TIPS because they don't have a yield. And as we know, we need a yield return. TIPS have a wonderful correlation to inflation. But I wonder if Jake can go to, I believe it's page 14 is a correlation matrix.
Yeah.
I've seen this too many times that I know the pages by heart. Yes, 14. And that if you look at the second to last number on the bottom, the US inflation. So one of the concerns that we have is at the stage of the cycle that we're in, that with the Fed saying that they're going to hold rates flat for 3 years, there's a tremendous amount of growth in the economy, and tacked on, if we add another 3 trillion in infrastructure, you know, you're talking about 25% of GDP in this very short order that normally would be associated with potential higher inflation. And so if you look at the inflation, one of the things that we spent a significant amount of time on is what asset classes do well in inflationary periods. And if you see that core real estate number at the 21, bank loans at 26, and specifically private credit at 38, those were ones that had some, you know, the hard assets typically do well in inflationary periods. Now, on the flip side of that, Mr. Chairman, as you know, long duration assets do not do well in that higher rate environment. So the real estate component is kind of a toss and tug and pull component on it, where it is a good inflationary component, but it has the negative long duration aspect to it, as you said. So that was one of the reasons that we looked at it, and so that's one thing that we really tried to get hold of, and that's why I'm kind of expounding on this. We didn't talk about it this much, but we increased our inflationary exposure by 20%. If you see the, you know, like in the total fund, we went from 17 to 21. So those are areas that we're looking at. So it's kind of a catch-22. There's some wonderful attributes of real estate, but the negative consequences of COVID have yet to be felt. And so we don't know what the retail outlook is. Is retail going to be significantly impacted for years to come? Will CBD, central business district real estate, bounce back? Will people continue to work from home, so you won't need those types of the same type of square footage in central business? These are all uncertainties. So I think real estate is a wonderful attribute, but there's some other aspects that could be problematic in years to come.
Yeah, and Mr. Chairman, I'll go on. And one of the things that we have done to kind of manage these is that, as you know, that the Odyssey is our benchmark, and you have to have so many percentage points of that of different kinds of assets in there, whether it's retail, office, industrial. And what we've done is look at, I guess I would call them boutique investments. And the one that we're really kind of excited about was, and the timing of it was going into last mile warehousing. And so we put a chunk of change in that to kind of balance out the aspect of overcompensating, I guess compensating for the over investment in some of the retail aspects. And then, as Patrick said, there are some questions out there as to whether or not in New York and San Francisco, whether people are going to move out and do more teleworking or teleworking, and those real estate assets will be, severely diminished for a long period of time. So I think when we look at it, to the extent that we can, I think we're going to try to pick and choose opportunities that will balance out some of the negative aspects of our whole real estate portfolio, and that I think has given us ability to help with the profitability and offset some of the problems that we've had with some of these legacy investments.
Well, excellent. I guess what I was getting at is being able to move quickly, which I think we've demonstrated on some of that. But also not saying, oh my gosh, the market's out of reach, and we've got to make the moves into it. So
yeah, it's definitely gone down. The cap rate is somewhere, I think, nationwide around 4.5%. And that varies. You'll find some areas where I'm sure we can get some 6-7% returns, but that's where, if we get some of these boutique opportunities and some smaller companies that are going into areas that have a higher return, then we'll be able to average up from the average.
Yep. Terrific.
All right. Well, let's see. I'll double check the agenda. I think we're probably getting pretty close to saying we've had our discussion. And do we get there before noon? My gosh, we got 20 minutes to spare. Does anybody want to opine for 20 minutes?
Mr. Treasurer, I'd just like to commend your office and your leadership. I think it's been great, so thank you.
Well, Mr. Governor, sing those praises over in the Senate right now. There's a couple of pieces of legislation. I know that if they, and this is a little aside, but I'm almost certain that if the legislature wanted to embed a LSO staff in your private cabinet meetings, you might put a pin to that, if it was coming out. So that's essentially what they want to do with my office, is embed LSO staff into the IFC meetings. So that just seems to be a little bit of a reach, and I'm looking forward, I think, into some aspects to going to the Senate and talking about the Santiago principles and letting them know that those guys didn't envision, a 90 board investment, a 90 member investment board to run our investments. There was actually a legislator on the House floor yesterday that said they should start getting into asset allocation, just exactly what we were doing here today. And they have all the authorization in the Constitution, I think, to do that. So it seems like it could be an interesting time for the future of Wyoming if we indeed start having the legislature get into asset allocation, because they've been empowered, Mr. Governor, to look at the Constitution and say that they can do anything they essentially want to.
Well, Mr. Treasurer, I appreciate that. I noticed there are, and let me look through the list again. I don't know if there are any that are on here today, but that was certainly the opportunity we wanted to provide them to put their input in. I think when we started this exercise, and I'm glad you've made it available to them too. I know that I don't believe there's any that have joined us.
Yeah, yeah. Well, just kind of a heads up on that as to some of the interesting comments that were made during debate. And usually something said on those floors doesn't, isn't left unheard.
Yeah.
Yeah. So come on down and have that coffee. I'll invite the whole team over. Well, I can invite one of you over. Maybe we'll do a round robin or something like that. We'll start with the superintendent.
All right.
Okay, guys. I think I'm ready for an adjournment. If you are, Mr. Chairman.
Absolutely. If there's nothing else that anybody wants to say. Superintendent, I see you're unmuted. Is there? Oh, okay.
Okay. Well, thanks again for all your guys' hard work, and you're always welcome.
Madam
you later.
Director, thank you.
Yeah.
Thank you, Mr. Chairman.
Thank you.
Yeah. Bye.
Thank you, Becky. Good to see you.
Great to see you too. Thank you so much.
All right. Bye-bye.
Bye-bye.